traction to end 2022. Still, Russia's downturn for the whole year was a fraction of the almost 10% downturn that was predicted a month after the invasion. The central bank put last year's drop at 2.5%. In Ohio, there's growing criticism over the response to a train derailment that spilled hazardous chemicals in a tiny town. The CEO of Norfolk Southern has pledged to ensure the safety of residents of East Palestine, Ohio, and that could cost millions of dollars. The train carried chemicals linked to liver and lung cancer. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
This is Bloomberg.
What we're seeing about the consumer is that they are using all of their sources of purchasing power. And the good news is that they still have a lot of purchasing power coming from the labor market, from job creation. So at the moment, you still have a lot of income flowing in, a disposable income, which is supporting that spending in real time. The consumer is out there able and willing to spend.
And you see that in the data. That was Michelle Meyer there, the MasterCard Economics Institute chief US economist, just fantastic. I promised you a better flavor of this story from Air New Zealand. Okay, so this is flight NZ2, all right? Was meant to have touched down at JFK Terminal 1. Terminal 1 had difficulties yesterday. What did they have, a power outage or something like that?
Correct.
Okay, ridiculous.
Terminal 1, I think.
So everyone started following this on Flight Radar 24 website, as we often do. It was halfway into a nearly 9,000-mile journey, and the Boeing 787 jet, Tom, had to make a U-turn just below Hawaii and fly all the way back to Auckland. Can you imagine?
No, I can't.
Can you imagine? You're going Auckland to New Zealand, or rather Auckland to New York. Get my words right.
No, I think that you're right.
Auckland to New
Zealand
rather
is
you
correct.
did go. In the end,
exactly
right. That's where you did go.
No.
And do you ever track the flight on the map?
Yes.
On the plane? I do that too. You think, oh, it's Hawaii. And then the plane starts turning around. I'd be furious.
This actually gives me agita. Looking at this story, it gives me agita because I think about how I would feel in that situation, and I throw some kids in there, and I throw some, exhaustion, a failed vacation, and you got to give a lot of free drinks.
Let's give Air New Zealand their opportunity to respond. The airline recognized that a diversion was inevitable after 5 hours and 30 minutes into the 14-hour flight. All options have been considered, and a decision was made to return in light of multiple factors such as distance traveled and operational circumstances. So that's the That's the statement from a spokesperson from Air New
There's
Zealand.
been a lot of these stories recently. There have been a number of them. We're going to do something different with Helene Becker. We're not going to get a single best buy on an individual stock. We're not going to complain to her about the cost to Paris or to Lake Placid this weekend for Lisa. What we're going to do is talk to her about the unspeakable. When you're Helene Becker at Cowen, you can write about it, you can think about it, you can experience. I'll cut to the chase, Helene Becker. When I was in school a long time ago, a friend of a girlfriend's family was a Pan Am pilot, and he walked on water. There was a time where these people were gods of the airspace. Maybe it touches to the DiCaprio movie, Catch Me If You Can. Things have changed. Do you have confidence in the pilot training? The pilots coming up from the regionals, are they the same as that god from 50 years ago?
So those are two questions, Tom. The first part of the question is, do we have confidence in the safety and security of our air traffic system? Yes, we do. The pilots of 50 years ago were trained during wars. We don't have that much anymore, so pilots now are more civilian trained. But yes, they all have this 1,500 hours of experience before they can work for a commercial airline. Unless they're in the military, they can have a fewer hours. But yes, it's gotten increasingly difficult to be a pilot because of concerns about safety.
I look, Helene, at the financial part of it, of recruiting pilots. Describe the pilot shortage and the reports recently that the major carriers are basically stealing pilots from the lesser regional carriers.
Yeah, they're eating their young. So here's the situation. And we've been talking about this since 2014, but the pandemic accelerated it. You have a group of pilots beginning in 2020, about 27,000 pilots are going to turn 65 this decade. So when you think about that, the U.S. airline industry employs about 57,000 to 60,000 pilots. So more than half, or about 45% of pilots were retiring, and they have to be replaced. Wow. And the U.S. only trains collectively about 5,000 or 6,000 pilots a year. So you were going to have a shortage anyway. Then you had the pandemic, and airlines asked pilots who were intending to retire between 2020 and 2022 to consider retiring in 2020. And the only airline that really didn't do that was United. They made different arrangements with their pilots, but others retired. Yeah. And then when things started to recover, not only did you have to hire back the 10,000 that retired, but when you think about growth, and you need roughly 5,000 or 6,000 pilots a year collectively for all airlines, you were hiring 14,000 or 15,000 pilots in 2022 in an environment where you're only training a third of that. So we were going to have a shortage.
Well,
and I'm sorry, go ahead,
no,
Lisa.
Helene, this all boils down to this question of consumer experience and how much of this is what's behind this shortage in capacity relative to demand, and an experience that, I mean, I can't blame this on why a plane turns around, but a feeling that things are kind of running more by a shoestring than they used to. How much will consumers put up with, given that this is a catastrophic experience for somebody who's on that flight, but if they want to leave New Zealand and go to somewhere else, they're going to get back on a plane?
Right. So I think the incident you're talking about was the one yesterday where there was a fire at JFK, and an Air New Zealand aircraft turned around halfway into the flight or something like that. Yeah. So here's the thing. You want to travel as a consumer. You've missed it. Maybe you haven't traveled that much in the last couple of years, and you want to get back, and you want to get back to experiences and doing things, and air is part, and maybe air is part of your vacation. And so you try to figure out the best way to do that. Traveling days of week that are maybe less popular, like Tuesday, Wednesday, Saturday, they're a little less popular than the other 4 days of the week. And then the other part of it is, for the consumer, we're seeing a lot of buy up from main cabin to premium economy or business class, but those fares are starting to go up a lot. So we'll see whether that lasts.
It's just a no from me. I'm not flying on a Tuesday. I'm just not doing that. If you take the week off, I'm leaving on Friday night.
100%.
I'm not flying on a Tuesday. It's
Yeah.
not happening. I need to clarify something I said a little bit earlier. I read you a statement from an airline. It was actually from Korean Airlines because there were 2 flights that had to make a U-turn. Can you believe that? Can you believe that?
Oh, it's
so that was
dreadful.
the statement from
Painful to
Korean
hear.
Airlines. Let me share the statement from Air New Zealand with you. And Helene, can you help us understand this a little bit more? They said diverting to another US port would have meant the aircraft would remain on the ground for several days, impacting a number of other scheduled services and customers. How messy can that get?
Yeah, so what happens in this case is pilots and flight attendants have duty hour limitations, and on a flight as long as the ones we're talking about, these over the Pacific 15-hour flights, you usually fly with 2 crews, right? You fly with your pilots who are flying the plane, and then about halfway through, once they reach their limit, you switch out crews, and there are different ways of doing that. Anyway, so the point here is if you divert to another airport, now your duty day is over, regardless of where you are, and now everybody has to rest for their minimum rest period, and then you have to get back, on the aircraft. But meanwhile, the aircraft is out of place because you can't just willy-nilly pick an airport, or you don't want to. You want to pick an airport where you have services, where you have a gate, where you have a ticket counter that can help the people on the aircraft get back, get to where they're eventually going. And then you have all the people who are intending to go back to Auckland, trapped in New York, in this case. So you have to get the plane there anyway.
Elaine, I want to finish on this.
Really,
Given the nature of the
ahead.
conversation we've just had for 5 minutes about this industry, American Airlines is up 29% year to date. United's up 30, Delta's up 16.5. I know over the last 12 months they've had difficulties, but these stocks have rallied so hard year to date. Why?
Right, yeah. So what Lisa and I were just talking about in terms of demand is very, very strong. Supply is limited. There are OEM, not only airframe delays from Boeing and Airbus, but you have engine delays, you have maintenance issues, parts that were turning around in 48 hours are taking weeks now, so aircraft are on the ground. So you have all these supply constraints, you have a lot of demand still, and you have very strong pricing, and fuel costs have come off their highs. So from a margin perspective, we're actually looking at least a very good first half of the year. Whether it carries through all year, we'll see, but we definitely think first half is going to be very good, and that's propelling the stocks.
Good for them and bad for us, as we all just have to suck it up, apparently. Helene, thank you, as always. Helene Becker there of Cowen. The situation, Tom, with the airlines. You're living it. You're living it.
I'm seeing some moderation in prices from absolutely outrageously stupid down to a little bit less stupid. I'm still fascinated. We didn't talk about it there. The ratio of business class to economy is comical. It's like 9-to-1 on some flights.
Oh, it's changing.
It used to be 3-to-1. That's as she said, people are legging up. We were using legging is the word this week. They're legging
in, legging up.
Legging up.
I think the staff right now are under so much pressure, but you can feel it that the customer service has just
I would agree.
gone downhill.
It's going to be tough. That's all I can say. I'm going to get out my bus.
Futures right now, down 0.8 to 1%. This is Bloomberg.
Chris, can I ask my landlord for a rent cut in the next couple months? Like, is that reasonable?
Well, I guess it depends when you signed your lease, Joe. It sounds like you got kind of one of those pandemic deals that, particularly in New York City, where rents actually fell really sharply in that first year of the pandemic. So we are really seeing the market having turned a corner a little bit over these past few months. Prices have been coming down for 4 straight months now in our national rent index.
Wow.
But, if you're still paying that late 2020 level, then you might not necessarily eligible for a discount at this point.
Good point. All right, I have another question, which is like, so I have 2 kids, but unlike other people, I actually am cool, and I don't want to move to the suburbs. Like, I want
This episode is just Joe taking like advice on handling his rent.
I just want to point out, I really like my landlord.
You love your landlord?
She's very attentive. We have a very good relationship. So even though I started the episode saying I was anxious, if she is listening to this, I hope she hears that I really enjoy where we live, and I really enjoy our the landlord.
She should factor your consistency into her pricing algorithm.
We've never been. Yes, exactly.
Excellent.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
It's just much harder to get a good read on the market, right? These moves are amplified, so you can't see that.
You've had a reversal from really extreme positioning at the end of 22, and that hasn't clearly ended yet.
Let's get some confirmation of the trend from a few more data points that hopefully align in one direction, and then get on that train.
Yes, inflation should ultimately come down. It's just going to take time. This whole cycle is taking time.
We at the moment have, in annualized terms, very little growth. We are kind of in a winter stagnation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Heading for the first 2-week loss of 2023. From New York City this morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures negative right now, down by 0.7%. The story of the week, Tom, just a continuation of better data and a lift in bond yields.
Yeah, big change, I think, in the bond yields. I think I do agree for equity participants, bonds is a place to start. And what we've done is shift from a 2-year dynamic to a real dynamic starting yesterday with a 10-year yield out to 3.89%. A 4-year, 10-year, it's there.
On the 2-year, Lisa had a look at 470 a little bit earlier this morning.
How many rate hikes can we put in, and then how long do they have to hold it this way? There's been a reset in terms of understanding this disinflation that perhaps wasn't as disinflationary as even Jay Powell was saying. And you're seeing that borne out through bond markets. You're also seeing it in currency markets. And this, I think, is interesting. The dollar spot index has actually given up almost all of its losses for the year, gaining against particularly the euro and the yen. So again, you're seeing that reversal as people start to price in more rate hikes in the U.S.
And the other thing is, and I thought that Damian Sessar was great in this yesterday and in select others, is the higher interest rate regime is really beginning to impact quality EM and the so-called frontier economy. And as we go to IMF, and I believe it's April, I'm sorry, you got to get through March with this new higher rate regime and some people that are going, Jerome Powell, what are you doing?
Also, Tom, if this continues, do we have to start thinking about DM debt problems? I had a couple of messages about that already this morning. As yields push higher again, we saw the problems in the UK. Very specific, unique, dare I say, what's the I word? Idiosyncratic.
Very good.
I won't use that too much because we know what happens when people throw that word around. It becomes broad. And I just wonder whether we have to start thinking about those issues all over again.
In particular, after the CBO report in the U.S., a lot of the increase in some of the debt really tied to some of the interest payments that they expect the U.S. to have to pay going forward. So again, these things can snowball in a way that people weren't expecting before.
To John Deere, and I mean, I come from a Deere family. Bring it up, chart banner, as you can. I mean, for those of you on radio, This is emotional, and you're going to tear up. John, you don't understand this, but if you were the it kid in your neighborhood in a ute, your father had an ice skating rink in the backyard.
Right.
And I mean, I was before this. We had the pull cart thing with the water coming out the back. But you're the it kid on radio if you've got the John Deere tractor with a Zamboni on the back.
That's like, do you buy the thing on the back as an extension?
It's separate. It's an extension, and it's a value add for John Deere. They make it's like a wheat combine in Iowa.
Are you suggesting that's why we got a beat and a raise from Deere this morning? Just this one product alone?
Just one product alone. The Zamboni 100 did it for John Deere. Chuck Banner, thank you for that. On radio, it's a gorgeous green.
Built their business around that. I feel like I have to translate you every single day. For those of you new to this program, Tom calls one of the producers Chart Banner, because they then have to put up a chart and underneath.
His grandfather was in Chariots.
It's very personal.
You know the movie Chariots of the Fire or whatever it was?
They've all got names.
I saw that movie.
They've all got names.
Yeah.
The latest from Deere, I'll bring you the numbers and try and make sense of it for you. Full year net income now seen at 8.75 billion to 9.25. They had previously seen a range of 8 to 8.5 billion. And the numbers today, first quarter EPS 655. The estimate was 553. The stock's higher in the pre-market.
John,
yes.
Free cash flow, I don't have it here because we're not back. Free cash flow, like $5 billion. $5 billion. John Deere, this pre-pandemic, now it's $7 billion. The pandemic, we're never going to recover from the pandemic. John Deere, $5 billion to $7.5 billion.
We could just do the whole program on Deere. 17 buys, 8 holds, 2 sells. We could go on and on.
And ultimately, it'll just be about Tom throwing out random things and John translating it and trying to pull it together.
Trying to get a discount, waiting for the ice in Central Park. You just see him going in, trotting along on a little tractor with an extension on the back. Thanks, Tom.
Did I nail it?
Are we done with Deere?
No, I got to give you a function. So Farrell gave you the services core services function this week. Huge splash with that. If you really want to tear apart a country, this is sort of new to Bloomberg. Deere Equity, MODL Go. This is, John, I didn't know about this. This is like everything on a company laid out, like a pro securities research analyst.
Thanks for that.
Should we move on?
I hope so, yeah. Futures right now on the S&P down by about 0.7%. I'll keep this brief. Yields pushing higher. We're back away from the highs of the session, though. We're back below 390 on a 10-year lease. So 389 up 3 basis points.
It's a light day today, but some of the things that we're watching, Fed Speak, there is tons of it. Fed Speak today includes Richmond Fed President Tom Barkin and Fed Governor Michelle Bowman. Both of them are going to be speaking within the next 2 hours or so. I'm curious how they push back against some of the move that we've seen in 2-year yields, or whether they actually endorse this idea of a terminal rate that's significantly higher than what they previously thought and held there for longer. Today, the Munich Security Conference begins. A lot of themes there, including U.S., China. But at 8:45 a.m., the European Commission's Valdis Dombrovskis is joining Maria Tadeo, and I'm very curious about the increasingly fraught relationship between the U.S. and Europe when it comes particularly to tech investments. And at 11:30 a.m., I know you're all waiting for this, Bank of France Governor François Villeroy du Gallo is speaking, and he actually is really out front. He believes in a soft landing. He believes in no recession, and he thinks that the ECB has to go much further. Does he reiterate what Isabel Schnabel said earlier this morning, that perhaps the market is underestimating inflation, John?
Pretty punchy stuff from Schnabel a little bit earlier.
Yes.
I have to say. We'll pick up on that later. Look out for this as well. Rishi Sunak, the British Prime Minister, sitting down with Maria Tadeo on a panel. I believe the Munich Security Conference.
He doesn't know what he's in for.
In the next 24 hours. Well, let's not get him to reschedule.
I've never heard Tadeo ask a softball question in his life. It's not there.
In conversation with Bloomberg, looking forward to that on Saturday, tomorrow. So we'll try and bring you some highlights as well on this program on Tuesday, because we get a long weekend.
We're going to see.
Get a long weekend.
You're going to bring in Robert Dahl?
I hope so, unless you want to talk about Deere again.
No, I don't want to talk about Deere. Bob Dahl knows Deere.
CIO, Crossmark Global Investments. Bob, we've asked this question already this morning, but given the pullback in equity markets and the rally we've had so far this year, what do you make of this most recent move? Is that something you want to take the other side of?
For starters, you guys are having way too much fun over there for a Friday morning. That aside, look, the Bulls have had the year-to-date run. I think it's going to be a year where we frustrate both the Bulls and the Bears. Now it's time for the Bulls to be frustrated. Look, the narrative has been, maybe the Fed's almost done. Inflation's coming down. I think we'll have a soft landing. I better buy some stocks. But what that ignores is we have the most inverted yield curve in 40 years. The LEIs have rolled over. Retail sentiments moved straight up to equal to the peak of a year ago. Money growth is negative. The impact of what the Fed did last year is yet to be felt on the economy. I think the market's ahead of itself, and we're going to give a lot of this back.
Bob Dahl, I talked to Andrew Slyman of Morgan Stanley yesterday, and he was absolutely brilliant. It was a clinic on what you and I remember, which is an actually normal rate environment. And what Andrew was talking about is, was everybody understand markets are looking forward and expecting out to the future. What's the Bob Dahl future look like that gives me comfort in owning stocks?
Well, I think for starters, we've got to get through this period of economic weakness. I'm going to call it a mild recession. I know that's not popular. It was fourth quarter last year, but now the soft landing school has taken over. I don't know how you ignore the list I just put on the table. We've got to get through that. And during that time frame, Tom, earnings estimates are going to come down somewhere. They come down a lot already. Stocks have a hard time moving significantly higher when earnings estimates are coming down. So I think some caution here makes sense.
Bob, Torsten Slok has been out front talking about a no landing situation, and he just put out this, giving a sense of what the market response would be to such a scenario. Basically, high inflation is a problem. The Fed is not done raising rates, which means that the trading environment from 2022 will be coming back, and the 60-40 portfolio will perform poorly. Do you agree?
I do, sadly. I wish I could answer differently, but I think the inflation takes a long time to get out of the system, and to think that it just peaked and is going to come straight down. Look, if the Fed really wants 2% inflation, they have massive amounts of work in front of them. Can we get down to 4, maybe into the 3s? Yeah, but nowhere close to 2.
Bob, real quick here then, what does that mean for 10-year Treasury yields, considering that they have been creeping higher after a huge flood of cash into longer duration for the first month of the year?
Yeah, I think that those rates have moved up appropriately. I couldn't believe how low they got. I suspect they'll stay where they are, maybe move a bit higher before we see the eyes of a mild recession and some more lower inflation numbers. Inflation's sticky. You guys know that. You've talked about it.
So, Bob, what do you want to own?
So I want to have a little of that 4.5% cash in my portfolio. I don't mind so much a nearly 4% 10-year Treasury yield. And in the stock market, I want to own a lot of the things that have not done well year to date, which are the things that did do well last year. Companies with earnings, reasonable valuations, good cash flow. The leadership has been the main stocks, companies that lose money last year, stocks that are heavily shorted. That's not quality leadership in my view.
Hey, Bob, great to have you on the program. Thanks for being with us. Bob Dahl there of Crossmark Global Investments. Bob's talked about it. I think Lisa Shannon of Morgan Stanley talked about it. Lisa's words were disconnect. There is a monster disconnect that needs to be reconciled. We've asked it a million times. Can yields stay at these levels and tech carry on outperforming? Which one has to move? And ultimately, in the last 24 hours at least, it's tech down and yields keep pushing higher.
My answer out of the pandemic is there's no analog for this. You know, people reaching back, trying to game inflation here, inflation there, markets here, markets there. There's no analog for this health crisis we're coming out of.
True. There's no analog for this inflation and where it's going to go, and the lack of understanding is definitely something that's causing a lot of angst for a lot of traders. The issue is it hasn't been one data point. It has been one after another, whether it's the labor market report, whether it was PPI yesterday, which I thought was interesting, whether it's the jobless claims that continue to be low, all of these building to this idea that perhaps people were over-enthusiastic about the disinflation narrative.
No more Fed. Can we talk about golf? Just briefly.
Please, yes, yes, yes.
You know, it was just
really something.
It's such a privilege to be able to watch Tiger Woods play golf. There's just something so special about it. And yesterday at the Genesis Invitational, alongside Rory McIlroy and Justin Thomas, and they both birdied, all three of them birdied the 18th. We're all smiling. It was just a joy, a pleasure to watch. Just fantastic. They tee off later this morning at 10:24 Eastern Time. For anyone interested.
This is before the Masters.
That's after the Open on Bloomberg TV. So, you know.
You have time to do
10:24.
I'll be in my surveillance.
I'm racing home to watch them tee off. It was just beautiful. It's just really special. It's great to see him back on the tour. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Two of the Federal Reserve's most hawkish policymakers are signaling they may favor returning to bigger interest rate hikes to fight inflation. Cleveland Fed President Loretta Mester said she saw a compelling case for a 50 basis point hike at the most recent Fed meeting. Now, that view was echoed by St. Louis Fed President James Bullard. President Biden expects to speak with China's Xi Jinping soon about that Chinese balloon that was shot down by the U.S. The president says he hopes, quote, to get to the bottom of this. At the same time, he said he makes no apologies for taking down the balloon. The dispute was highlighted just how fragile relations are between the U.S. and China. Ukraine's ammunition and weapons gap will dominate the Munich Security Conference, which began today. EU and NATO officials have called for an increase in arms production to address expected shortfalls. Meanwhile, the UK Defense Ministry estimates that up to 200,000 Russian troops have been killed or wounded since the start of the war almost a year ago. The federal judge overseeing the fraud trial of FTX co-founder Sam Bankman-Fried is threatening to send him to jail. Judge Lewis Kaplan wants severe restrictions placed on Bankman-Fried's use of electronic devices and apps. There's concern over his use of encrypted messaging app Signal to contact FTX's U.S. General Counsel, a potential witness in the case. And in Germany, shares of Mercedes-Benz are higher. A share buyback and strong fourth quarter performance helped offset its projection that earnings will slip this year. Mercedes' $4.2 billion buyback is its first in 15 years. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Innovation strikes. Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane. We refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
There is still some misunderstanding as to how Europe works and how Europe reacts to the Putin shock, but it's more open-mindedness now. Equity markets in Europe can rally, even with central bank liquidity going down, and the same actually holds for the world economy. Europe's biggest problem is hopefully transitory. That's the Putin problem.
August Meeting there, the chief economist at Berenberg, weighing in on the ECB and Europe. You've been waiting for this, haven't you, from Villeroy? Yeah. Got a headline from him. Inflation now too fast, possibly persistent. Inflation rate may halve by mid-2023, but ultimately, even if it does halve, it's still problematic, isn't it?
He's been talking about the ability to raise rates and still have a soft landing or a no landing or no recession in the euro region, and is confident that they can do both of those things. We're starting to hear more pain discussed again, and that perhaps might get the attention of markets.
There seems to be a distinct separation spread between what you heard there from Holger Smeeding on the European economy, Tom, and the nature of the war in Ukraine. Things there are terrible. They haven't gone better. at all in the 12 months through the whole of this war.
I strongly agree with you.
And yet the way we talk about the European economy is, yes, relatively speaking, things are better and maybe we don't have to confront the kind of winter that we all feared, but that doesn't tell you anything about the nature of the war that's still breaking out in Ukraine.
I totally agree with you, and I can't get to my perception of a World War II analog because I don't think it was like this with a real war, like whether it was pick your war, but I find the separation, John, to be remarkable.
Well, look at this headline from the central bank official over at the ECB. Government should cut aid as energy costs ease. I think they're worried about some of those fiscal transfers to individuals because they think it boosts prices.
Holger Schmieding he was basically glossing over that, saying you're not exactly having that, and it's just more drawn out, and so it's not as inflationary. But you're seeing a much broader based inflation beyond just the energy costs that you're seeing.
Yep.
We're going to stop right now, and we're going to do it with all the work our team has done and Bloomberg News reporters across the front of Ukraine in the last year. Maria Tadeo is at what was the beginning of all this was February 19th of a year ago. Maria Tadeo, Mr. Zelensky was at your Munich security conference where you'll speak to Prime Minister Sunak tomorrow, and he said there are 30 children in Donbass and they're not going to NATO, they're going to school, which they never did. Explain your experience of the distance from a year ago.
And Tom, what a year it has been, because that was President Zelensky a year ago here at this hotel that you see behind me, the Bayou Shahov, iconic for the Munich Security Conference. But also remember that speech where he said, Ukraine does not want war, but we are ready for it. And at the time, everyone in the audience, they hesitated. They thought this war would make no sense, that Vladimir Putin would not go for it, that there was still a wait for a diplomatic solution to this. And now, a year later, you have a full invasion from all the ways, by the way, Crimea, the east of Ukraine, Belarus too. We are seeing potentially a new offensive. The NATO Secretary General says you do not have to wait for the spring. This offensive is already underway. And meanwhile, Ukraine, which says we need the weapons, we need the training, are also prepping for their offensive. I think overall, for many people here in this conference today, what a year it has been, but also how wrong they got it.
And the uncertainty of the news that's out there, I saw something that said that Russia's committing 90% plus of its material to the so-called front of this late winter in Ukraine. Do you buy it, Maria? Is the intelligence that they're putting everything into this new effort?
Look, I think it's always, when it comes to Russia, it's difficult to tell what is the truth and what is propaganda, the different intel that we get. But I was told by a very senior official who told me, yes, the war has been a mess for Russia. They were hoping this was going to be a quick operation, a week potentially. It's now a year. But do not underestimate the capabilities that Russia may still have. And do not underestimate that this is a huge country with a massive population. At this point, by the way, if you listen to NATO, they also say Vladimir Putin does not care. He is willing to wage a war with a high casualty rate. That means sending thousands of units that you know are probably going to die. But if that's what it takes to move the front line, he is willing to do that.
Maria, in certain governments, there is a degree of fatigue emerging after sending a lot of cash, a lot of money, a lot of financing and weaponry to Ukraine. Do you see that across Europe? Just how united are the Europeans?
And yes, Jonathan, and before that, can I just say I completely agree with you in terms of the dislocation. When you look at the battlefield and the situation in Ukraine, Ukrainian officials will tell you the next few weeks will be very difficult. Then you look at the Bloomberg terminal and you get a headline that says gas prices dropped below 50 euros megawatt hour. Remember, in August, at the peak of the energy crisis, that topped 300 euros. So there is a disconnect between the energy war and the actual war. That is something that, not just I agree, but I think we should really stress the difference between the two. Now, on the message, politically, yes, they still say we stand with Ukraine and that is not going to change. But there is a very interesting debate, and we're not talking enough about it, which is the assets from the Russian central bank. There is a growing debate behind the scenes, and this would be unprecedented. It's never happened before. Is there a way to confiscate and use those assets to rebuild Ukraine? Because everyone here now realizes the bill from this is going to be enormous, and their taxpayers should not pay for the damage that Putin has created.
How much is the sort of, I don't want to say complacency, but this feeling that people can move on and sort of curtail any kind of worries about the Ukraine war and what Russia is doing. How much is that tied to this feeling that it's not going to escalate? Because if Vladimir Putin was going to escalate, he would have already done so.
Look, I think behind the scenes, in fact, it's the opposite. You know, there's a lot of uncertainty, and this is the thing that I've been told repeatedly 24 hours. The conference is about to start, so of course a lot of things can change from now to Monday. But the mood here is uncertainty. It's the next few weeks, and this idea that a lot in this war could be decided between the spring and then the summer. That's why the Ukrainians are pushing for the training and the weapons as fast as possible. They need that for their counteroffensive. So there is a sense that a lot could be played out in the next few weeks, and that will be crucial. The other point, I'm not sure if compliance, but what there is relief. This idea from the European side that the energy war at this point has flopped for Vladimir Putin. Measures that they took, but also the fact they got lucky with the weather. This was not a cold winter for Europe. The question, and this is an answer for the time being, is how do you fill up the storage for next winter without the Russian gas?
Maria, I'm fascinated with your conversation with the Prime Minister. John and I were talking about it, and I'm just absolutely fascinated how you will approach it. John, how do you approach it from where you sit?
The Prime Minister?
Yeah.
I'm not here to tell Maria how to do her job. I want to know how Maria's going to do it tomorrow. Maria, what are you looking for tomorrow in that conversation?
Look, to me, this is the timing of this is fantastic, because the idea is that in the next few weeks, the UK could finally put an end to the issues around the Northern Irish Protocol. And not to get into the details, but what this could mean if that deal is finally achieved is that this is the final episode, finally, of the Brexit tensions. And that feeds into a change in music from the UK. Remember, for years, we've talked about a country that is no longer a big geopolitical agent, that is retrenching from the world. I'd be surprised tomorrow if Rishi Sunak does not push back against that narrative. What the UK wants to say is we still matter, we're a big country, and we're decisive when it comes to European security.
Looking forward to it. Just a fantastic conversation coming up tomorrow. Yeah. In conversation with Maria Tadeo, Rishi Sunak, the British Prime Minister. We have a long weekend stateside, so no doubt we'll pick up with some of that sound, Tom. On Tuesday, for us, I believe that Bloomberg TV will be running with that all weekend into Monday.
I mentioned this the other day, John. I'm absolutely fascinated by, you know, all the heritage of the continent of Europe, and from Boris Johnson to Mr. Sunak, their commitment of the debate, I should say, in the UK versus in America, where there's a tangible debate about use of ammunition. The Secretary of Defense saying we need to build up our ammunition as well.
Sure.
And I'm fascinated how the Prime Minister will address that.
2 words: continuity. Yeah. It continues. Whoever's leading the British government, and proximity. They're just so much closer to it, Tom. And this is the interesting part of all of this, that when you had the energy crisis alongside the war, you could leverage what was happening in the energy crisis to get support for the war. And Maria was painted the picture pretty clearly for all of us, Lisa, that ultimately, as the energy crisis starts to fade, you start to see that fatigue set in for the war, but there's nothing about the war that's fading at all over the last 12 months.
Not at all. In fact, it's actually in some ways escalating, and people are preparing for something that's really dramatic. What she said there about how a lot of businesses and a lot of nations in Europe are preparing for the recovery and the rebuilding of Ukraine. This is something that, if you talk about this behind closed doors, they're all preparing for some sort of rebuild and what potentially that could mean in terms of economic growth.
You see gas prices?
They're the lowest since when? I mean, they've just been plummeting.
Down hard by another 4% over in Europe. Futures are off by about 6 or 0.7%. Yields have been higher through the last 24 hours. We were through 470 earlier. We've backed away from those levels since. From New York, this is Bloomberg.
best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping. Look, people have conviction, or they invest for the. If they invest for the right reasons, just keep at it.
Dentist was a genius about a month ago. Turned around to me, just an absolute genius. Turned around to me and said, "You need to make an appointment. What time?" And I said, "Okay, what have you got?" And they said February 20th at 10 a.m. And I thought, 10 a.m. February 20th, that's great. They're around the corner from work. I'll finish work and I'll go around the corner. I'll go to the dentist. Then I found out, what? Monday's a day off. So I've got to wake up. I've got to wake up on Monday and go, genius. And now I can't change the appointment because you have to pay. Right, you get charged. Yeah. America. Very, very smart the way they did that.
I did not know.
It's just like February 20th. How does that work for you? 10 a.m. We've got lots of space.
John, I have so built into me, John, February 12 and February 22, that I did not know it was President's Day until yesterday at about.
You forgot?
Yeah. No, I'm just I'm as idiotic. I mean, I'm way past my prime. And the bottom line here is, John, I'm thinking February 12 and February 22. George is 22. Mr. 1809, Abraham Lincoln, is February 12. He'll be great, you know. What we need to do, Lisa, it's really emotional. When you become a U.S. citizen, the surveillance team will be with you.
A few more years.
Down at the city.
I've got a few more years. Really? Live on air.
It's really emotional.
I was going to say,
I was blown away.
Do you know why I do it? Just to stop the haters and the trolls from saying, go back to where you came from. I'll be like, I'm American.
Well,
you know, you think they'd still say it anyway. All right, futures right now on the S&P.
No, not at all.
Looks like this. We're down about 0.7% on the S&P 500. Yields look like this in the bond market. They've been pushing higher over the last 24 hours. We look a little something like this on a 2-year, up by 4 basis points, 468. Earlier on today, we had a new high for the year, and that new high of the year was 471. It's not just the US story, it's Europe too. We keep going back to this. Europe pushing back against the disinflationary hope that's existed and persisted through the year so far. And I would say exacerbated by the officials themselves, who said that the disinflationary process had started, and now all of a sudden they're unhappy with the pricing because I guess the data's turned. I don't know. Euro dollar just holding on to 106. And Lisa, to your point about dollar strength, here it is for you. Euro dollar negative 0.5%.
I couldn't agree with you more in terms of officials kind of feeding into this and whether they're perhaps thinking, maybe we shouldn't have done that. Taking a look at some of the stocks on the move. Do you know that Deere reported earnings this morning? I don't know if you guys picked up on that, but they did. And they were better than expected. They were significantly better than expected, with cash flow exceeding what it was before the pandemic by a significant margin. All incredibly rosy, and the shares are just up 2.4%. And I think that that is interesting. And what it tells you is the distinction between companies that have already done well and been bid up and those that haven't. Deere shares are actually down on the year after having gained 25% last year and 27% the year before. So this has been a haven stock, and perhaps a lot of people are kind of factoring that in rather than just going wholesale based on earnings beats. DoorDash is interesting to me also because they beat expectations, raised their guidance yesterday after the bell. People are still getting a lot of delivery. that is what this says. This screams disposable income, and people are willing to pay for a salad to get delivered to their homes. And that is what basically we're talking about here.
I don't want to catch you unawares here, but I have no idea what DoorDash is. Which brands are they?
Caviar. Have you got caviar in New York?
No, I don't. Which brands are DoorDash?
Caviar.
Oh, caviar is a delivery?
Okay. I'm not talking about eating caviar. I'm talking about the food delivery service.
The delivery service is called Caviar. I don't know.
Haven't you ever ordered out and then you can click the delivery service that you want? And they're sort of like, comparison. Well, anyway, this is one of them. So people keep ordering takeout, and that's why those shares are up.
I find that the McDonald's on Lexington gets it to me faster than the one on
do
3rd
that
Avenue.
through Uber Eats. But you know, DoorDash, just quickly, Lisa mentioned the salad. If you order a salad now, it's double the price by the time it arrives, right?
Oh, there's a few add-ons.
If you do sweet green, it's like $15 for a salad. By the time that you get to the bottom and you put on a tip, and I like to tip nicely, you know, I'm doing my bit as a proud American. I like to tip well. I do, yeah. And by the time you've done that, it's double the price.
Oh, yeah. I mean, honestly, ordering in is really expensive. But, like, one of the reasons why I go pick up is also because I want to tip nicely. But then sometimes if I don't really want to justify the expense, then I feel guilty. And then it's this whole, internal thing. Anyway, moving on. DraftKings is the other one that I wanted to take a look at. Sports betting. People are betting on sports in an incredible fashion. These shares are up more than 56% year to date and are up 8%, additional 8% in pre-market trading.
Do we have details that they got a Super Bowl pop? I mean, they must have.
I'm sure. They were looking at fourth quarter earnings, and that's the reason why people were excited, but the guidance also came in hot. So,
I gave a speech out in Las Vegas years ago, and I remember standing in Caesar's Palace looking at all the betting stuff.
Sure.
And how foreign it was, and now it's like
everywhere.
in England. It's everywhere.
Yeah, it's everywhere. My producer Jamie this morning showed me his winnings.
You have a producer? I don't know.
Yeah, have you not got one of those?
No.
How
it's
much?
Very good.
How much?
I'm not sharing him.
How does he have a producer?
He made 800 on a $10
It's a union?
bet.
Seriously?
Doing great. He's doing fantastic.
This is turning into a...
No, I'm not sure if his wife's watching because she might not know about the results. So if she is, Jamie, congrats. You've got to spend that on flowers this weekend. Futures were negative 0.75%. We've had a ton of Fed speak. This from Jim Bullard, I think, is a key line from the St. Louis Fed president. All that talk of long and variable lags, here we go. I've pushed back against the long and variable lags argument because I think in the modern era, the transmission of monetary policy is much faster than it would have been in the 50s, 60s, and 70s. We need to talk about this, Tom, a whole lot more.
We're going to address this towards March 22nd, and this is Milton Friedman in Chicago and another time and place, and the elasticities, what the electrical engineers call the slew rates of our economy now is different. And the gentleman from Indiana would say, I didn't go to Chicago, I went to Indiana. I'm looking at the reality
So
out there.
we're saying, Tom, the reality is, and you've mentioned this a few times over the years, the increased financialization of this economy
is part of it, absolutely.
Means that it hits quicker.
Technology, what Trichet would call the diffusement, and he says it with a French accent like Lisa's. And
Communications changed?
Yeah, diffusement. It diffuses through the system different there.
That word.
Like
Would you like Lisa to do that in French?
Diffusement.
I'm not even French, and I'm vaguely offended.
Vaguely, that's not the normal user. She's totally offended. Saving us is Lindy Rossner. She's portfolio manager at PGIM Fixed Income. And to give you Greg Peters' question here, it's real simple. Price down, yield up. What does PGIM do when it's price down, yield up?
Yeah, it doesn't necessarily mean that we do anything differently. As I said before, we are long-term investors. How we entered this year was we understand that there's a feel-good rally going on, but we've always felt that it felt too good. And we haven't been chasing risks here, and that's been purposeful. So the fact that yields are a little bit higher, that's okay. That plays into how we thought that this year may play out, which again is one of security selection and not one where we're banking on spread tightening.
Well, when you talk about security selection, let's talk about the overall market, particularly in high yield and how much it's tightened. We heard last week one of our guests talking about how it's almost frothy in terms of how much demand there is. Do you think it's gone too far?
Yeah, I think there are pockets of the market that have gone too far. I think the outperformance in triple Cs is not really warranted, given what we think is going to happen in terms of economic conditions. We've obviously gotten a lot of positive data just even in the past week, which means that the Fed is likely to be more aggressive. You see that priced into the forward. As a result, the likelihood of a soft landing, a garden variety recession, even maybe a small chance of a hard landing, that's all there. And the story triple Cs are telling you I don't think is that story. So that seems to be an area that we think is certainly frothy. But again, there are names that have value that hasn't been fully realized in high yield. It just goes back to that security selection and finding them.
I've been struggling with some of the simple narratives because it does feel like a very different time and a very confusing one to get your head around. Jim Bianco of Bianco Research was talking that perhaps we are misunderstanding the neutral rate, that perhaps we're not even at excessively restrictive at this point in terms of expectations for the terminal rate. And that's what we're feeling. And that's the reason why risk assets can continue rallying, even though the Fed's been lifting rates. Do you adhere to that view?
Yeah, I think it's a big debate. Clearly, we're all having it. We're all trying to understand it. The Fed as well. What is this R-star guidepost? But what it feels like to us right now is that we're starting to see that those rates are in fact becoming restrictive. I think an important thing to remember is not every rate that's important or pivotal for the consumer is off of the front end. And we haven't seen, obviously, as much move in the 5, the 10-year as we have seen in the very front end of the curve. So I think as that starts to shift through, we're going to see that kind of impact. And I would say we have felt restrictive territory. We're not at the peak, potentially, but it's definitely starting.
Lindsay, away from the sophisticates like you and Mr. Peters and the rest at PGIM, people just look at something like the Bloomberg Total Return Index. It was down, let's say, 14% last year, and there's a presumed recovery, price up, yield down. Is that at risk? Are we in jeopardy of seeing a leveling out of price, or dare I say even an aggregate price down, yield up by year end?
I think there is always the chance of that, but we started this year at a very different position than where we were last year, which is we've got a ton of interest rate hikes already there. So we've got cushion on the Fed side. And then we've also had cushion on the spread side. Obviously, spreads have rallied to Lisa's point. But we're in a different position, and I think that can still allow for a positive total return. But it's not going to be a straight line. And that's what we've seen so far. You know, you look on your Bloomberg terminal, and we're up 2.75%, and then maybe we're off 1.75% from a total return perspective. So don't expect a straight line, but we think it's going to have positive total return given that cushion I mentioned.
If Ken Rogoff models out 6% rates up from 5.25%, if James Bullard of St. Louis shocked us with 7%, how does your world change if we get a terminal rate lifting?
If we get that terminal rate lifting, we would be in the camp that is going to be so restrictive on the economy that the Fed would be forced to cut and cut more aggressively. So we are in that camp, back to your prior question, of feeling that this level is restrictive. And therefore, if you go higher, 6%, 7%, that's going to be ever so more restrictive. And we're going to have an economy that is choking, and that we're going to have to come off those levels to a more normal rate. So that will be some pain kind of in the interim, but I think we get back to a place that's better in the end.
It's such a complicated moment, Tom. It's so complex.
Yes, that's the
Lindsay,
theme of the
thank
week.
you.
Yeah.
Lindsay Rosner there of PGIM Fixed Income. We all make it sound easy by saying things like, but there are long and variable lags, or we just aren't sufficiently restrictive and they need to do more. And ultimately, you're going to be in one camp or the other. But having the incoming information that allows you to make that decision with confidence and conviction, I'm not sure how many people have that.
Which is the reason why perhaps the message from central bankers has been rather muddied. So Villeroy has continued to speak, and he says that he wants clearer communication and that the ECB could guide on the duration of the terminal rate and needs to keep rates high as long as possible.
We've definitely changed his name 5 different times in the last 2 hours, haven't we? You're just killing it. Euro dollar, 106.18, negative 0.5%. Stronger dollar. The yield move fades a little bit. The equity move fades a little bit too. We're still down about 0.6%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden is trying to keep the dispute over the Chinese balloon that was shot down from escalating. He says he expects to talk soon with Chinese leader Xi Jinping. The president disclosed his plans as part of his most extensive remarks yet on the balloon saga. He said he wants to get to the bottom of the matter, but doesn't apologize for shooting it down. Meanwhile, President Biden's doctor says he's healthy and vigorous following a routine physical examination. The oldest ever U.S. president is expected to face scrutiny over his fitness as he prepares for a widely expected run for re-election. His longtime doctor says he is fit to successfully execute the duties of the presidency. Russia has avoided an economic collapse in the aftermath of Vladimir Putin's invasion of Ukraine. The country logged its third straight quarter of contraction to end 2022. Still, Russia's downturn for the whole year was a fraction of the almost 10% downturn that was predicted a month after the invasion. The central bank put last year's drop at 2.5%. Deere has raised its earnings guidance above analyst estimates. Higher crop prices keep farmers spending, and that's led to a record windfall for the biggest maker of farm machinery. A year ago, Russia's invasion of Ukraine sent wheat futures to a record. Deere is betting that crops will stay pricey, enabling farmers to replace aging fleets of tractors and harvesters. And a bidding war could be brewing for Manchester United. Bloomberg has learned Qatari investors, including the country's former prime minister and ex-head of the Qatar Investment Authority, are preparing a roughly $6 billion opening bid to acquire the English football giant from the U.S. Glazer family. British billionaire Jim Ratcliffe has already lined up financing. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
The top names at the Fed are on Bloomberg.
Inflation is normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far. But if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
At this juncture, the incoming data have not changed my view that we will need to bring the Fed funds rate above 5% and hold it there for some time. Indeed, at our meeting 2 weeks ago, setting aside what financial market participants expected us to do, I saw a compelling economic case for a 50 basis point increase, which would have brought the top of the target range to 5%.
Well, that's news. That was Loretta Mester, the Cleveland Fed president, not voting this year, but still participates, attends, and contributes to meetings, and basically saying she saw a compelling case to go 50 basis points at the last meeting. Jim Bullard of the St. Louis Fed, Tom, laid it on as well. Going into the next one, is that going to be part of the conversation?
Let's be sure for those that don't keep score, it was John and I were living this in real time. There was market move yesterday, and then there was the word 50, and that was the beginning of the real move.
You know, claims came in, downside surprise, good news. PPI came in, upside surprise, bad news. And you stood there thinking equities rolled over, but it was when Mester spoke, Lisa, that you got that additional move.
It was a 1-2 punch. First, you had data that was reconfirming the sort of strength that we saw, that persistence in labor market tightness, but also inflation. But then you have Fed officials calibrating this differently and coming out as more hawkish and talking about pain. She mentioned pain again, and I keep going back to that. The more they mention pain, the more they're they're willing to tolerate more weakness in the economy as the balance of risks tilts more to inflation.
Do you want to talk about the lack of pain? Have you seen the home builders? The home builders, the low on the home builders in the last 12 months was last June. And since then, Tom, the home builders on the S&P are up more than 50% over that period, from the lows of June to where we are now. It's pretty phenomenal, the move.
Absolutely phenomenal. There's no question about it. What we're going to do here, John, you know, like when there was a construction site with a hammer and a nail, they said, "Why don't you take the day off, Mr. Keene?" I am the worst with a hammer and a nail.
Did you work on a construction site?
I did concrete. Yeah, I did a lot of concrete.
Okay.
Yeah.
How did that work out?
It was, I learned a lot. It was back when, you know, you didn't go off for, 3 weeks in France or whatever. You actually went out and got a job, they're taking how much out of my paycheck? We used to have a 6-pack of Jenny Cream Ale for lunch and it wouldn't even faze us. That's what it was like.
Is that where you built a resiliency team?
That's where I got the resiliency from. Let's move on. Drew Redding took hammer and nail at Drexel University and joins us right now. He is expert on Home Depot, Lowe's, and the rest of it as well. Drew, I measure Home Depot when I go out to 3rd Avenue and I see the number of contractor trucks in the lanes outside Home Depot. Things look pretty good. They're lined up always 2 lanes deep, and sometimes they'll take a 3rd lane on 3rd Avenue. How good is it for the resiliency of Home Depot?
I think your point on what you're seeing with the contractors is an important one. Home Depot has about 45% exposure to the professional contractor, and that's really what's buoyed results and led to their outperformance versus a Lowe's, which has about 25% exposure. So the reason that the professional customer is doing so well is because their backlogs are still pretty healthy. You have to remember, going back to the pandemic, a lot of projects were put on hold when we got into 21 into 2022. Consumers got more comfortable. They started taking on these larger projects, and contractors didn't have enough labor to get them all done. So their backlogs started building up. So they're still living off those healthy backlogs. We do think that as we get into the middle part of 2023, those backlogs are going to start to thin out. And at the same time, we think there is a little bit more pressure on the DIY consumer.
Drew, Home Depot to me is the under-discussed Apple computer. They've done 19.6% per year for the last 10 years. Do they have an addressable market that lets you envision that out into the future? Maybe not 19%, maybe 15%. But does the home builder market that John was talking about, is it something that can grow in size over 5 or 10 years?
So absolutely. We think, right now, whether you're talking about the home builders or whether you're talking about the home improvement market, we think we're in a cyclical downturn that falls within a broader long-term positive demand trend, and particularly for the repair and remodeling market where Home Depot and Lowe's like to play. We do have some pressure on disposable personal income, which, as we said, we think pressures DIY, but longer term, the fact that mobility in the housing market is so low because inventory is low, there's a disincentive for current homeowners to move because rates are so high. We think that you start to see a lot of remodeling on current residences rather than moving. At the same time, a large portion of the housing stock is coming into the age where you would traditionally see a ramp in remodeling spending. So we do think that once we get through this air pocket over the near term, there is a longer term runway for growth in home improvement.
A lot of people agree with you, Drew, and we're hearing that perhaps the bottom is in terms of the weakening trend in housing, and it's going to reignite, especially because mortgage rates seem to have plateaued and even come down a bit, although they are creeping back up. How much does this really speak to this sense that home prices are going to remain high, rents are going to keep climbing, basically torpedoing this idea that we're going to enter some downturn that's going to help soften the inflation and the cost of housing?
Yeah, so it's a good point you made with rates. We saw rates come down 100 basis points from November to early February. And during that time, what we heard from the builders and from the broader housing market in general is that there was a reemergence of demand starting in mid-January and into early February. That's not only because rates have come down, but it's because builders are willing to play ball now. They're willing to cut base prices. They're willing to help with incentives. They're going to buy down your interest rates. So they want to play ball because they need to turn their inventory. But, you also made the point that over the last couple of weeks, rates have moved back up. We're up about 75 basis points. And now the rate on the 30-year is about 6 3/4 again. So to the extent that we stay at this elevated level or even creep higher, we think that we could see demand start to slow down a little bit more.
When you talk about creating new housing stock, what type of housing is gaining traction? I remember when the McMansion was hot, and then it was this sort of modular, more basic homes for entry level buyers. Now people perhaps moving to more basic things. What's sort of the hot trend?
Yeah, so you could see a clear trend over the last couple of years from the beginning of the pandemic, where square footage was increasing because people were working from home. The home had to take on a lot more functionality. But now when you're in the middle of an affordability crisis like we are now, you've started to see the median square footage of homes trend lower. And I think that's something that's going to continue because builders have to find a way to get that price lower because they need to make the math work for buyers. So they'll do it through lowering the square footage on a home. They'll do it through increasing the density within their community, so more homes on smaller lots. Or they'll do it through the product itself, which is more townhomes because they want to increase that density. They could spread their fixed costs over a greater number of units.
Drew, one from me, just a quick one. It's something I'm thinking about, and I'd love your insight on it if you've got any. Haven't we got a whole generation of home buyers now locked into mortgages of like 3% with no real incentive to move anytime soon and maybe ever? Drew, how do you think about that situation given what we've seen take place over the last few years?
Yeah, I think that's an important point. So something like 80% of the current outstanding mortgages are sub 4%. So like you said, there's a real disincentive to move. And I think that's why we haven't seen the explosion of inventory in the resale market that a lot of people were calling for when rates started to rise and the economy started to slow. At the same time, it goes to what we were talking about before. People have a disincentive to move, but they still need more space. So they're looking at their current home and they say to themselves, why don't we reinvest in our home? Maybe we'll add square footage. We'll make the changes that we want to our current home.
Interesting. Just a fascinating conversation. Drew, thanks for your insight. Drew reading there of Bloomberg Intelligence. 80% of the market is sub 4. 80%. 80%. So when Jim Bullard talks about longer variable lags and he pushes back, how does that factor into it?
Well, and actually, there's a whole market that people are talking about restarting, where they basically just change the title on the mortgage to the new home buyer. They buy it out so that they get the low rates. This was back to like the 1980s, and they're kind of trying to think about reprising that kind of action.
But the difference here, John, this is the singular U.S.-UK difference. I'm sorry, when you have that fixed rate locked in your world, that's not true.
A fixed rate a couple of years, maybe.
Yeah.
Maybe, or you've got a floating rate where you just adjust off the back of bank rate every time they hike. That's tough.
I come out of here. I go to 3rd Avenue. I stop at McDonald's for the surveillance breakfast, and I walk up a block to Home Depot. And I go downstairs, John, and it's not too early. The Home Depot's right below us.
Have you ever been there?
Yeah, I go often.
No, he hasn't. I have. He has.
I have,
John, I mean, I'm sorry. They've got the 9-foot Feel Real Christmas tree. This is with 1,000 dual-color LEDs for $1,178 for a fake tree.
I didn't pay that much at Home Depot. I think it was
I'm stunned at what I had no idea what fake trees cost.
And they did a great same-day delivery service as well. When
they do, they're very good at that.
Ordered from them, they were fantastic.
They're very good.
I don't think it was DoorDash. It come with a salad brand.
And what's great, Lisa, is John has it where they throw the batteries in, the Duracells in. So the color thing that turns, so he gets a different color.
Why are you so envious of my Christmas
It's year-round.
Yes, and he doesn't have the colored lights. I'm sure he has just the white lights.
He FaceTimed me, and he was like, tearing up. He was so jealous. It was just sad.
Our tree did not make it to Epiphany because vet bill peed on it.
How many times?
Did you decorate it this year?
No, we didn't decorate it.
So most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone, and it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you would be.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Comes down to inflation. Do we get back to this disinflationary trend, or do we see a plateau?
I don't think the disinflationary story is over, but we have to be aware that it's going to take time.
The disinflation story was not destroyed by the CPI. It was actually reaffirmed, but it was the Fed hawkishness that's kind of standing out in the market right now.
Equity markets in Europe can rally even with central bank liquidity going down, and the same actually holds for the world economy.
The economy, we don't think is going into recession, but there will be some deceleration.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. What a strange week it has been. And John, for me, the proxies, the benchmark 10-year yield, it says all about the shock of our economics, finance, and investment. A 362-ish out to 389 right now, higher yield.
Yeah, I'll raise you 470 on a 2-year, a little bit earlier if you want an even higher yield than that at the front end of the curve off the back of really stellar data and hawkish Fed speak, Tom. It's really been the story of the week so far, maybe the last couple of weeks.
Let's get out to March 22nd. What does it do to the broad disinflationary retreat we're seeing? I wonder what a guy like the iconic Edward Hyman does at Evercore ISI, looking for sub 3% inflation end of the year. Does he amend that in the coming days?
Chairman Powell in the Federal Reserve News Conference said the disinflationary process has started. Then when he spoke at the Economic Club of Washington after that big payrolls report, he qualified it. He said it was just in the goods sector. I wonder if we hear from him next time whether he says it at all, based on the information we've had so far.
Our guest quality is everything. It's Prime Minister Sunak with Maria Tadeo tomorrow. Edward S. Hyman with us next week is on the schedule as well. Lisa, I look at this, and to me it all distills down to our certitudes, and we sort of had this whisper of, okay, maybe the housing agony's over. Baloney. For me, the single thing I did this week was that rent thing on New York City, where I compared rents to income, everybody's falling behind, and with rates up, we fall behind again.
The disposable income gets squeezed as inflation runs hot. You talked about the 10-year, Tom. John raised you with the 2-year. I'll raise him with the 6-month. If you take a look at that yield, it's 5.02%. It's now the highest level, a new post-2007 high, which speaks to what you're talking about, Tom, which is this idea of, if you get a Federal Reserve that's responding to true inflationary pressure, it creates a much more negative situation than this sort of immaculate disinflation.
Here's a phrase for you: reinvestment risk. Brian Levitt of Invesco a little bit early this morning.
Yeah.
What do you do? Take the high yield on a 6-month T-bill and face the reinvestment risk 6 months down the line because this rate environment isn't there anymore? Or do you lock it in for a little bit longer?
To me, this is a very difficult debate to really weigh in on. And I guess what we're hearing from a lot of investors is you got to do a little bit of both because you can't have any conviction. Do you have conviction that we're going back to a 2% inflation world where the Fed can effectively control that?
That was tested this week.
Right. Well, and do you have conviction that the Fed and frankly markets are willing to accept the pain required for that? Do we need a recession to get back to that type of scenario?
Where's the recession?
Exactly.
I mean,
But that's
one of
exactly
the
the
interviews of the
point.
week was Michelle Meyer at MasterCard. She's got more knowledge than anybody on the street with their charge card, their credit card knowledge and all that. And I'm just going, where's the recession? I don't know if it's there.
Do you remember Dominic Constam of Mizuho, who came on the program and he said it looks like a soft landing until it's a hard one? Well, it looks like a no landing until it's a hard landing if you speak to Michael Hart of Bank of America, because ultimately the belief now is that, yes, in the meantime, we can use Neil Dutta's phrase, Torsten Slog's phrase, Michael Hartner's phrase, everyone's talking about it, no landing. It means the Fed has to go harder, and then they think the real pain comes later. All I know is we came into this year and people were looking for one thing: a dreadful market and an awful economy. And they got a rip-roaring market to start the year and a pretty decent economy. And let's see if that changes. Futures right now on the S&P down 0.6%. Equity struggling in the last 24 hours off the back of this lift in the bond market. Tom talking about 390. It's about 389 now. We're high by 3 basis points. On a 2-year, up 5 basis points on a session. Just short of 470. 471.33 is your new intraday high of the year. Tom right now 469 on a 2-year.
On a Friday, reading into the weekend, a good time to speak to Beata Kerr, Managing Director, Co-Head Investment Strategy. Thrilled that she's with us this morning with Bernstein. Beata, thank you so much for joining us this morning. How do you amend and adjust off the last 3 days' festivities?
Well, the story is all about disinflation, and we are not willing to give up on the disinflation story. We just think it's going to take time. And you were just talking about it. The goods have declined. And if you look at the CPI basket, that's a third. The other 2/3 is clearly the problem today. So we've got owner equivalent rent, which still has to decline. But normally that takes 15 months after the CPI peaks. So that could be a quarter or two away from now. And then the other challenge is wages. And you're starting to see companies take action here. Of course, the employment numbers haven't reflected that yet. But we're in the camp of a couple more rate hikes for the Fed, but not giving up on the disinflation story by the back half of the year.
This is totally irresponsible, but it's irresponsible Friday. What does March look like? Your idea of short term is Q3 or Q4. Help our viewers and listeners with a prosaic, what's March look like?
Well, you're right, Tom. At Bernstein, we really think much more long-term than 1 month from now. But at the moment, we have our estimate at a 25 basis point rate hike. And then we added a May rate hike after this week. But look, there's a lot of economic data that's going to come out between now and then. We know the Fed is very data dependent, and we see things have tilted. So it's possible you get in the 50 camp, but that's not where we're at right now.
Beata, I want to really double down on what John brought up, which I thought was a really important point, the reinvestment risk. Where do you go in terms of specific types of bonds, maturities of bonds at a time where you're getting 5% to own 6-month Treasury bills?
Yeah, we recognize the inverted yield curve poses a challenge, but we think for anybody that's looking to invest for beyond 6 months, think about intermediate duration, high quality munis. They just took it on the chin last year. The credit quality is still high. The rainy day funds are high, so we really don't see default risk in that space. And the tax equivalent yields are close to 5% in that high quality sector. And it will pay off. You're getting price appreciation there as well. And they're really off to the races already this year. So we would barbell between the intermediate duration in the public bond markets with thinking about private credit in the alternative space, because there we're seeing yields now north of 10% on new loans that we're issuing. So we really think this barbell between the public bond markets and the private bond markets is something that's new and quite attractive for investors today.
Where do stocks fit into this?
Stocks fit in right in the middle. We started the year actually with our base case of a range-bound market in the mid to high single digits. Of course, here we sit in mid-February, and we're already there in terms of the stock returns. So we've had the most challenging earnings season in decades, yet the market's so buoyant. So you're seeing this week, I think, a lot of give back on that. We might see some downside in the short term, but focus on quality. Focus on the companies that can manage margins. The story of the year is wages. Last year, the story was goods. So who are the companies that can manage their cost structure and really lock it in? And they're still out there. So it's all about individual stock selection.
Where are you finding them? Is it the PepsiCos, the Coca-Colas? What are the names? Where are you finding those names?
Yep. We've been adding recently to names like United Health and Visa. We like Microsoft as well. So again, it's really not a sector specific bet. It's about the companies that have been able to be successful in this environment. We're not making a call on really one sector in a particular way. You have to just be looking at the individual company and their ability to manage the cost structure.
What do you do with growthiness that already trades at a high multiple? I guess Apple's the lead victim at a 25, 26 multiple, but nevertheless there's growth of cash flow, maybe use of cash fades into it. They've all been stars. Do you underweight? Do you just hold them and pray? I mean, what's the approach there?
Well, if you think about what is in the growth index, obviously it's a lot of technology and a lot of healthcare. And if you think about technology in a disinflationary world, and the companies struggle today to manage margins, in many ways, companies are going to continue to add to technology. That innovation is going to be disruptive. Whether it's AI or simply software upgrades, that's an excellent way for companies to manage costs. I mean, I'd prefer not to be replaced by ChatGPT, but the point is that there is real opportunity for corporations to continue to purchase in the tech space. So here, Tom, I think you have to look at what's the composition of growth, and we think there's a long-term buy into that sector. So we're not shying away from growth characteristics.
Have you tried to use ChatGPT? Have you tried to use it?
A member of our team tried to rewrite our market outlook with it, and we were relieved that it was not nearly as good. So
I hope you send that to the boss.
Our jobs are safe.
That's good to know. Got Kerr there of Bernstein Private Wealth. That's wonderful, isn't it? I wonder how many people have actually done that.
You know, I actually have had this debate, very heated debate at home about writing papers, theoretically, for younger offspring who have, you know.
How are they working that out? You know, I saw a great line, and I wish I could attribute it to who wrote it, but I don't remember. But just for the record, it's not mine. And they said, you know, math had to change once the calculator came out, and, you know, the education system's going to have to adapt and shift. And not pretend it's not happening and try and ban it.
Right.
Teach them in a different way. Clearly, it doesn't have to be a memory test anymore. These things are going to exist, and people will have access to them.
I think that's a really good way of putting it. You have to have critical thought, and there has to have some. Although the problem is that ChatGPT can sort of fake critical thought on the margins, probably as well as some high school students can fake critical thought.
You know, I trust here. Kevin Roos was iconic at New York Magazine. I think he's at the Washington Post this week. I can't remember. Maybe the New York Times. He did a blistering thing in the last 48 hours where he went to Bing or whatever and did fake-o AI stuff. And he said it was frightening what the output was. I mean, are we sure this stuff works?
Well, no, they've actually.
I'm asking seriously.
Right now, there's a huge investigation, particularly into certain inherent biases in these programs that are coming out in what you put in and what you get out. And it's really problematic because you could potentially spawn a much greater degree of bias in some of this
Political
stuff.
bias.
Political bias, social bias, all sorts of things. And it becomes this problem.
I mean, I'm really, as I mentioned earlier in the week, I'm under huge pressure. I've had meetings on it, on the triple leverage all cash GPT fund.
How's it going?
Fund or ETF, you know, we don't know really which way to go, but AI is going to come into our world. Are we going to do Chat GPT on inflation? I mean, I just don't see it.
Can you imagine a little computer here instead of me?
What's McKee do?
Hey, AI is already in our world. We already do stuff here at Bloomberg on the print side in Bloomberg News Time with automation.
Yeah,
it's already happening.
But that's not gaming inflation.
But it's a tool, and this is the point with a calculator. How do we use it as a tool to make people more efficient?
I agree. They've got to adapt and adjust, Bremo.
I think so.
That's
the
what they've got to
resilience
do.
of the
corporate
They need
America.
to take statistics. I would recommend a knowledge of the central limit theorem. Thank you.
Can you explain that for us, Tom?
We'll do it in a on the
ChatGPT will do
break.
it.
Small boxes on the break.
Okay. Futures down 6/10. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Two of the Federal Reserve's most hawkish policymakers are signaling that they may favor returning to bigger interest rate hikes to fight inflation. Cleveland Fed President Loretta Mester said she saw a compelling case for a 50 basis point hike at the most recent Fed meeting. That view was echoed by St. Louis Fed President James Bullard. President Biden expects to speak with China's Xi Jinping soon about that Chinese balloon shot down by the U.S. The president says he hopes, quote, to get to the bottom of this. At the same time, he said he makes no apologies for taking down the balloon. The dispute has highlighted just how fragile relationships are between the U.S. and China. In Northern Ireland, British Prime Minister Rishi Sunak told politicians that significant progress has been made toward agreeing on new post-Brexit trading agreements for the region. Still, there's no deal yet with the European Union. An agreement would resolve how goods move between the region and the rest of the UK. The federal judge overseeing the fraud trial of FTX co-founder Sam Bankman-Fried is threatening to send him to jail. Judge Lewis Kaplan wants severe restrictions placed on Bankman-Fried's use of electronic devices and apps. There's concern over his use of encrypted messaging app Signal to contact FTX's U.S. General Counsel, a potential witness in the case. And in Germany, the two largest airports have come to a virtual standstill. Security and other ground crew in Frankfurt and Munich began their one-day walkouts early today. That left Lufthansa to cancel 1,300 flights. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
I think stocks can have a decent year. You know, the mystery is less why are stocks up versus why are parts of the market leading that really shouldn't be leading, and environmental rates are still climbing. But I do think we have an environment where, look, we're getting closer to the end of that Fed cycle.
Russ Kostrick there of BlackRock. How much closer are we getting to the end of that Fed cycle? Because now we're talking about a return maybe to 50. That's going to be highly dependent on the data in the next couple of weeks. And if we get a repeat of January for the February economic data, then wow, things are going to change. In the equity market, we're down 0.6% on the S&P 500. Yields have been higher through the last 24 hours. Tom talked about a 10-year through 390. We've talked about a 2-year through 470. At the start of this month, I think the low was 4.03%. intraday on a 2-year. And that's changed very quickly, Tom, off the back of the data.
Well, the movement's substantial. We don't need to go over it again, but the curve inversion's been flipping around here just in the last 48 hours or so. But I would suggest, John, actually, it's the first thing I thought about when I got up as we're getting really close to the Pharaoh start of the year, which is March 31, where people rewrite the outlook at 12/31.
I'm telling you, it would be a great research team. When we set one up together, three of us, and we put out our research, Bramho's just going to be that, uber bear. What's that guy over at SocGen? I forget his name. But you're going to be like a mix of him and Nouriel, and that's going to work really, really well. And I'm just going to say, as research director, just to help you guys out.
Oh, thank you. I appreciate that. You're beside yourself, research director.
Because he needs it. Tom's chief economist. I'm going to say that we only put out our year ahead outlook on March 31st.
And then we look back at the previous
It's going to be different.
Yeah.
I mean, it's going to be different. Things are changing. We've talked about housing in America. Where is that going to head here? What will the disinflationary crude do after what we've seen the last 4 days? And part of that is expressed in oil, which we all know is impossible to predict. It is the toughest thing. $5 a gallon for gas, down to 3.09 a gallon of gas. And Julian Lee knows, yes, we've had a pop, but not a technical breakthrough to higher gasoline prices. Julian, how do you correlate a barrel of oil and the guesstimate to $100 a barrel, it hasn't happened, to a gallon of gas or a liter of petrol? How do they correlate?
It's a really difficult correlation to make, I think. I mean, if you look in Europe, you've got a very heavy slug of taxes in there. They don't change. Whatever happens to the price of crude, those taxes stay fixed unless governments change them. And so the movements in the oil market actually have a much more muted effect on petrol prices in Europe. In the US, you don't have quite the same balance or quite that same slug of taxes, but still you don't see a one-to-one correlation ever between movements in crude prices and movements in gas prices. Although I think that correlation is much, much stronger in North America than it is perhaps in Europe.
Let's talk about Europe, because we've seen a dramatic move in natural gas prices. This is where the crisis was supposed to happen that didn't. We saw prices surge to almost 350 euros. If you take a look at what's traded in the Netherlands, coming down to less than $50, going back to almost where it was before the Russia's war in Ukraine. Is this justified by the fundamentals?
I think the fundamentals of European gas are very tricky at the moment. Yes, we've come through most of this winter intact. We've seen temperatures that have been much higher than perhaps a normal winter. That has certainly helped. We've had a big inflow of gas from the United States and elsewhere, which has helped to offset the loss of a lot of Russian supplies. But I think that Europe is, we're not out of the woods yet by any means. And I think that the next winter of 23-24, is going to potentially be at least as difficult as people were anticipating that this winter might be. We may not have the mild temperatures again in the coming winter. We almost certainly won't have the volumes of Russian gas that we had, reduced though they were still flowing into Europe for much of 2022, which helped to rebuild gas stockpiles ahead of the winter that we're now slowly coming out of. We won't have those next year. And so I think there are certainly very few reasons to sort of think that Europe has weathered this storm completely. We've got off to a good and perhaps a lucky start. And I think that the vagaries of the weather have certainly played into the movements that we've seen in gas prices.
Julian, some people would push back, and they would say, actually, Europe has done a lot to rejigger some of the supply chains of where they get natural gas, going more to Qatar rather than what they had seen from Russia, and not only building supplies, but building a sort of more diversified backdrop. Do you disagree with that? Do you think that that's been overstated?
I certainly think that those things have happened. I mean, we have seen significantly more liquefied gas coming into Europe. We have seen the infrastructure starting to be put into place to allow that to happen. More infrastructure will go in. But I think you have to remember that Europe has survived on several very large gas pipelines from Russia. Those pipelines during 2022 worked to some extent, nowhere like as much as they have done in the past. We saw the closure of the pipeline beneath the Baltic Sea, for example. We've seen the end of flows through Belarus and into Poland. But those flows did contribute to stockpiles that Europe had available at the start of this current winter. And they probably won't contribute to stock building during 2023. And I think that's something that European governments have to bear in mind. Steps have been taken to reduce consumption. They need to be continued.
So in summary, what is your probability, totally unfair, but let's go there. What's your probability of seeing $100 Brent crude? Is it a Julian Lee, not a chance in hell, or is it something a little larger?
I think it's a little larger than not a chance in hell. I mean, at the moment, markets are looking relatively well supplied. The concerns around higher prices, I think, are very much for the second half of the year. And are very much linked to expectations of a rebound in consumption in China and strong growth in the demand for jet fuel. But right at this moment, I think the market is digesting suggestions of more rate hikes in the US, and this very large build that we saw in crude oil stockpiles in the latest weekly data out of the US Department of Energy. It was the fourth biggest increase in commercial crude stockpiles in more than 30 years.
Julian, we have to leave it there. Thanks for being with us. There's so much to talk about in this commodity market. Crude, natural gas, as Lisa mentioned, in
Down
Europe.
70-some% in America.
It's phenomenally low.
I mean, somebody must have made a lot of money, but think of the number of people.
I'm sure.
You know, oops.
I was just looking down because I saw some headlines from Chancellor Scholz, so I'll bring you those headlines right now. He calls for balance between support and avoiding escalation. I think it's going to be a really interesting line in the next coming weeks because there is some talk of providing jets to Ukraine. And that line from Chancellor Scholz calls for balance between support and avoiding escalation. Because he also says in the same address, this line, to support Ukraine as long as necessary. Now, that's all well and good. The real question is how. How will they support them?
Especially if they need the Air Force power right now, because the anecdotal reports have said that Russia is building up, amassing an Air Force push into Ukraine heading into the summer. And that's going to be really important for them to have the ability to defend themselves against. So where does escalation kind of start to pick in?
All nations, Tom, that can send battle tanks should do so. I just wonder where they stand on jets if that conversation comes up over the weekend.
Yes, and I saw one headline fly by. These are huge historical baggage issues. What I would do is what nobody's doing. I would watch Mr. Putin. I would watch Mr. Putin, every image, every photo, every comment, every moment he has.
Coming up to 12 months since this war started. Tons to talk about in the next hour. Looking forward to this conversation. Mohammed Al-Arian, top of the hour on Bloomberg TV. From New York, this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
Bloomberg Surveillance, Lisa Bramowitz and Tom Keene, John Farrow, in preparation for Dr. Al-Arian here, and among others in the next hour. Futures negative 28. The VIX, I should point out, I haven't mentioned it all day, almost near 17, and then we had a non-disinflation. It was a transitory move, Lisa, from 18.x out to 20.88. It's been a abruptness to a pullback in the equity market.
Yeah, although I really am wondering about this narrative shift that we've seen this week and how much it really is going to have lasting power, whether the data continues to confirm this, and whether stocks have truly reflected what we're seeing in the bond market. I mean, we heard from Peter Scheer earlier saying that really the bond market is the place that really is more of the signal, and the stocks right now more of the noise.
Well, speaking of noise, I'm so glad you segued to that very nicely here.
Thanks.
We're going to bring in a gentleman right now, Seth Carpenter, at least for this Friday, as global chief economist at Morgan Stanley. He is extinguished. I looked at one of the beauty contests out there. He's sandwiched between Daley of San Francisco and Goolsbee of Chicago. Seth, I know I'm going to get the niceties from you here, but let us begin in the Derby to replace Brainerd and a vice chairman. Explain to our audience what the vice chairman actually does.
So when I was there on staff, it was a really important position, worked very closely with the chair and the president of the New York Fed, who is the vice chair of the Federal Open Market Committee, and really helps to steer the strategy for policy, not just for the next meeting, but sort of over the course of the next few quarters.
There are schools of thought here, and one of the things that's so important is the politics of Capitol Hill and the basic idea of Main Street, Wall Street, and might I even add the academics of Princeton or Jason Furman's Harvard, he's on the list, Goolsbee, Chicago. Have we politicized the Fed in the last number of years? Is it different than when you studied at Princeton?
So I'd say the world goes in lots of cycles. There are very famous episodes back in the late 60s and into the 70s, and the interactions between President Johnson and the Fed chair, and whether it was appropriate to tighten policy while the U.S. was fighting in Vietnam. So I think there have been periods where there's more politicization. There are periods where there's a bit less. I think the main thing from my personal experience is that the people inside the Fed tend to be very, very focused on what their mandate is, and they try to block out the political noise to the degree humanly possible.
The mandate being to really bring inflation down to that 2% target. And that mandate is getting harder to wrap your head around right now because we don't understand the contours of inflation. If Jay Powell were having his Fed press conference right now, do you think that he would mention disinflation, as John was mentioning earlier, as many times as he did during that press conference?
I have to say the last data print does make things, a little challenging to read exactly. The fundamental story of some disinflation from core goods and some hopefully coming disinflation from housing, that's generally still intact. You never want to fully change your worldview based on 1 month's worth of data, but there have been some surprises, and it wasn't just one data series. The non-farm payrolls report for January was strong. The CPI report had some surprises. The retail sales report was strong. All of those have to make you wonder, is there more resilience, underlying resilience for the U.S. economy? Now, we've had the view for a long time that we'd have a soft landing, that we would not go into recession this year. That view was hard to hold 6 months ago, 3 months ago even. Now I think the market's coming there, and the conversation is shifting. Are we actually getting a re-acceleration instead of a slowdown at all?
Can we get inflation back down to 2% if we don't get a recession? And this, to me, is really the underlying question of a lot of what we're discussing, because, yes, there is momentum, but this is only increasing the expectations for Fed rate hikes.
I mean, my baseline view is yes, you can have inflation get back down to target without a recession, but it's a narrow path. It's pretty difficult. You need demand to be reined in so that there isn't consistently and for continuing several quarters, overall demand that exceeds the ability of the economy to produce. Now, we know the U.S. economy is still somewhat understaffed outside of tech. And I think it's that residual sort of catch up in hiring that's giving some support to what's going on. But if we can get the economy to slow down fundamentally, open up a bit of slack in the labor market without causing a recession, that's possible. It's tricky to do, but that's exactly what the Fed's trying to pull off.
Seth Carpenter, I was reading on Portugal, of all places, in their housing crisis, and it seems like every nation has a housing crisis. Are we modeling out housing inflation correctly, or is it a squishy or changing set of data that we're going to have to adjust down the road?
Housing inflation, there's a very strong sort of philosophical argument here. The way we measure housing inflation in the United States is not on home prices. The BLS's theory, if you will, is that they want to separate out homes as an asset versus the flow of housing services that you get. And so that's why we have this concept of owner's equivalent rent. And when the BLS measures housing inflation, they look at quotes on rents, and then they try to ascribe that obviously directly to people who are renting their homes, but they also try to ascribe some of that to people who own their homes. It is what it is at this point. That's the way that housing inflation is measured in the U.S.
I did a completely amateur apples to onions analysis this week, Dr. Carpenter, and I looked at the rent increases from the pandemic beginning in New York City and approximated the income increases, which are tangible, but it ends up with a plug of a negative 12.5% over 3 or 4 years. I mean, does the Fed understand the angst all listeners and viewers feel about the housing economy, and then what do they do about it?
So my sense is yes, the Fed does understand that there is a challenge here. What you pointed out is that real wage growth has been negative because overall consumer prices have been rising faster than people's income. Now, in general, what that does is it tends to crimp people's spending behavior. And we have seen over the past couple of years a notable slowdown in consumer spending growth. So how does it affect housing directly? Well, what needs to happen is a bit of a pullback for housing specifically. That's usually tied historically with increases in total employment. So a slowing in the labor market will help there. The 517,000 non-farm payroll print doesn't go in that direction. But there is something special about this cycle with COVID. We did see a surge in demand for more housing space, people wanting to live alone because they're working from home, people wanting to have more space. And I think there's part of this shift that was COVID specific. The challenge, of course, is sorting out the cyclical part of inflation in housing, the cyclical part of demand in housing from a strong labor market, from that idiosyncratic COVID-driven part of things. I don't think anybody believes that a COVID cycle is 100% normal business cycle.
We're speaking with Seth Carpenter of Morgan Stanley, the economist who previously was at the Federal Reserve, who has a long and storied history in this particular sphere. And I'm curious about your process this week and the past couple of weeks, as we've seen this data come in hotter than expected, causing your team to increase their expectations of terminal rates, to increase how long the Fed was going to hike rates. but then also to increase the rate cuts on the back end. Can you talk about the process of how much your view shifted?
I think the key right now is trying to figure out how much underlying momentum there is, and as a result, how much the Fed needs to raise rates. I think, as far as we can tell now, the Fed strategy remains tighten policy, have the economy slow down enough that you can be very certain that you're going to be on a glide path back to 2% over a couple of years. The last several data points have not been consistent with that outcome. And so as a result, more tightening is what's necessary for the Fed strategy. I think the open question, and the part that's very, very difficult for us to know, for markets to know generally, and for the Federal Reserve to know, is just how far is enough. And part of that is how much was the 517,000 jobs a one-off, like it was in July of last year, and how much of it is an indication of underlying strength. Inherently difficult. How much of the strength in January's data for retail sales, for non-farm payrolls, for inflation was because of changing seasonal adjustment that's going to come out later in the year, because seasonal adjustment has to be zero sum over the course of a year. Very hard to know right now.
Yeah.
And so that's what we've done, is we've said, with the data available now, and then if we go to the March meeting, what data will the Fed have available? It'll be clear things are stronger than they thought, so they'll hike more then. We get to the May meeting, what information will be available to the Fed then? Another month or so worth of extra data. They have to take data, not 1 month changing their view, but on the sort of accumulated history of data. And by the time we get to May, it's very hard to see why they would have concluded that everything is hunky-dory at that part. And so that's why we put in those extra hikes. What would lead to even more hikes? What would lead to, for example, yesterday, Loretta Mester talking about 50 basis points being on the table? I think if we get clear evidence that January's data were not an anomaly, but were a shift, an inflection higher, if we get another 400,000 non-farm payrolls, for example, I think they have to be talking about the 50 basis point hike.
Seth, just real quick here, 20 seconds. Do you think that this all takes us further away from a soft landing?
It's a mixed bag. I'll say no for now. It's hard to say that a stronger economy results in a weaker economy that doesn't sort of follow on its own. The tricky part is the Fed has to react if it's a substantially stronger economy, and it's always been difficult to gauge how much to tighten. So it's a bit of a mixed bag. Maybe at the margin, greater chance of a hard landing, but for now, we're happy to stick with our soft landing story.
Dr. Carpenter, thank you so much. Seth Carpenter, at least for now, with Morgan Stanley. Thank you so much. Well, I love the list. It really shows the strength of American economics. Mary Daly's on the list from San Francisco. Jason Furman, of course, teaching Ec10 up at Harvard. Goolsbee, who I've known for years at Chicago. I think he's now Chicago Fed president.
Yeah. So just
Either
for
that
people,
or he's pitching for the Cubs.
For people who are just joining us now, we're talking about the potential nominees for the next Fed vice chair to replace Brainerd. So this is the question that people have.
This is important. I want to bring this out. I haven't had time to get it out on Twitter yet. I will. Bloomberg Green, run out of London, is one of our best things. And Kyle Stock released moments ago, Lisa, about what you and I have talked about, which is there's a lot of EVs in New York City, but may I quote, New York City is largely an EV charging desert. Like, you can't get your car charged.
This is a big issue. How do you build out that charging station network in order to make this a viable model?
I'll get it out. It's must read for anybody considering an EV car. I'm keeping the Nash Rambler.
Yeah, the Hummer.
No. The Nash is a smaller vehicle. Stay with us Saturday, Tadeo, with the Prime Minister of the United Kingdom tomorrow. Good morning.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden is trying to keep the dispute over the Chinese balloon that was shot down from escalating. He says he expects to talk soon with Chinese leader Xi Jinping. The president disclosed his plans as part of his most extensive remarks yet on the balloon saga. He said he wants to get to the bottom of the matter, but doesn't apologize for shooting it down. Russia has avoided an economic collapse in the aftermath of Vladimir Putin's invasion of Ukraine. The country logged its third straight quarter of contraction to end 2022. Still, Russia's downturn for the whole year was a fraction of the almost 10% downturn that was predicted a month after the invasion. The central bank put last year's drop at 2.5%. One of the biggest car dealership chains in the U.S. expects prices for new and used cars to fall this year. Still, AutoNation doesn't expect sales to return to pre-pandemic levels in 2023. The company reported higher than expected earnings in the fourth quarter, but gross profit on new cars fell 13% from a year earlier. Consumers continue to borrow more to fuel their spending. According to the New York Fed's Household Debt and Credit Report, Americans racked up nearly $1 trillion in credit card debt in the fourth quarter. The $61 billion increase from the prior quarter was the biggest since 1999. And they're missing payments, too, with delinquency rates surpassing pre-pandemic norms. And a bidding war could be brewing for Manchester United. Bloomberg has learned Qatari investors, including the country's former prime minister and ex-head of the Qatar Investment Authority, are preparing a roughly $6 billion opening bid to acquire the English football giant from the U.S. Glazer family. British billionaire Jim Ratcliffe has already lined up financing. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We still anticipate moderate growth if should the battlefront and the war continue into the Ukraine's benefit. We do anticipate little growth in the margin of like 2% at the end of 2023. The economy suffered a lot because it's obvious that the challenges we're facing are not coming without consequences.
Alexander Gryban of Ukraine there, and of course the troubled economy, getting some growth there and a lot of assistance. I know the IMF considering further growth there. Lisa Bramwitz, Tom Keene with you. John Farrell. We'll have Dr. Alarian along here in about 15 minutes. He understands the dynamics of Europe better than most. You do that when you are prodigious in his physics. Valdis Dombrovskis is a former Prime Minister of Latvia and continues his public service to the continent as European Commission Executive Vice President. On an historic moment in Munich, a conversation with our Maria Tadeo. Maria?
Thank you, Tom. And he does, and he's also very good with numbers. And let's talk about this, Vice President. Thank you so much for joining us on this. Good afternoon. How are you on this conference? I want to ask you, it's been a year now, and we all remember a year ago, Vladimir Zelensky was here, and he said, we do not want war, but we have to be ready for it. Now we know it turned into a massive invasion, destruction in the country, but also unprecedented sanctions on Russia. But I have to ask you, for many in Europe, there's this idea, okay, there's sanctions, but Russia continues to move along. It's a zombie, but it's still moving. Are these sanctions working, in your view?
Well, sanctions are working, and I would say the very fact that last year, despite record high energy prices, Russia was still in a recession, and most forecasts also expect a recession in Russia this year to continue. That's a direct impact of sanctions. One can discuss that probably sanctions on Russia's energy were coming relatively late last year. In a sense, if they would have earlier, the effect would have been bigger, because that's the biggest source of
How much
Russian
do they
revenue.
lose today on oil revenue, would you argue?
Well, we know those estimates vary, obviously, but it's true that through European oil embargo, through oil price cap at G7 level, through now oil products price cap, they're running substantial losses, and actually their budgetary surplus has completely evaporated.
And can I ask you, today we saw gas prices drop below 50 euros megawatt hour, which is completely different to the situation in the summer. Would you say the battle to weaponize energy, he's lost it? He made a bet and he lost that bet.
Well, strategically, he has lost it.
He's lost.
It doesn't mean that we will not have still our share of difficulties, because we need to prepare the next heating season. This winter, there were still lots of Russian gas in European energy storages pumped primarily in the first half of last year. This is not going to be the case this year.
So
we still will need to seek substantial additional supplies. Well, we have upgraded infrastructure quite a bit. We have agreements with many alternative suppliers, so it will be possible, but it will be done in a context where also China's economy is more opening up, and we may expect higher global demand for gas. So it still will require quite a bit of work on the European side. But strategically, I think it's clear that we have moved away from this dependency on Russian natural gas supplies.
Forever? That's done?
Well,
Russia's an energy player for Europe. It's done for good?
I would say it's done because, we also have our European Green Deal and aspiring for climate neutrality as of 2050. And that's, among other things, in general, foresees gradual phase-out of fossil fuels.
And either way, the Nord Stream is done, kaput, some will say. I want to ask you a question, a yes or no answer on this question. There is a debate behind the scenes, perhaps we should talk about it more, which is what to do with the frozen assets of the Russian central bank. They have been frozen now for a year, but there's this idea that at one point they could be confiscated and that be used to rebuild Ukraine. Are you in favor?
Well, I'm in favor because it's
to
Russia's...
confiscate and use the money.
Well, exactly, because it's Russia's responsibility as an aggressor state to pay the reparations, to pay for the damages it has created to Ukraine. It's unlikely that Russia is going to do it voluntarily, so we need to look at confiscated Russian assets. And actually, if you look now at the 10th sanctions package, which we are now putting forward from European Commission side, one of the measures is exactly to have precise overview of how much frozen Russian central bank assets there are in the EU.
And just so an international audience gets this has never been done before to this scale, to really confiscate another central bank. Many would argue the problem is if you do that, the G7 jurisdiction is out the window. What do you say to that?
I would say unprecedented situations require unprecedented measures. We are facing unprecedented war, aggression against sovereign European nation. It requires unprecedented response. If we remember historically, for example, Nuremberg Tribunal did not have some kind of pre-existing legal framework. It was created as a response to the World War II and German aggression. So here it's similar, that we may need to think outside of the box, and probably we need to create new legal framework to deal with this.
And that's a fascinating point. You can really feel the mood around this conversation has changed. Nobody wanted to talk about it. Now you increasingly hear about this confiscation of assets. But I want to ask you, for this to work, you need the banks to report the client relationship that they have and to play along. Will you do that? Will they do that? Are you already in conversations with the European banks? We need to know what you have.
That's exactly what we propose now, as I said, in a context of 10th sanctions package. Of course, member states need to agree on this, but that they need to report on how much frozen Russian central bank assets there are in each member state, so that we can have an overview on states need to agree on this, but that they need to report on how much frozen Russian central bank assets there are in each member state, so that we can have an overview on what is the situation. And also, for example, it concerns sanctioned private entity assets that we need a better tracking system.
And the oligarchs, too, who, of course, have lost their big properties in Europe. Mr. Dombrovskis, thank you so much for joining us on Bloomberg today at the Munich Security Conference. Well, a lot going on here, but to me, that's a key point that perhaps is worth now paying more attention, is this idea of what to do with the assets from the Russian central bank. Never been done before to this scale, but you heard it from Mr. Dombrovskis. Unprecedented situation may require unprecedented tools.
An historic moment. We thank Maria Tadeo for everything, including from the Polish border and all her work over a very difficult 12 months. Tadeo, in conversation with the Prime Minister of the United Kingdom, this will be on Saturday. We will have it for you on a delayed Tuesday because it is Abraham Lincoln and George Washington's birthday. And of course, London television will have full coverage of this on Monday. I look at the Telegraph just as a litmus paper of conservative zeitgeist in London. I don't know if I'm accurate on that. I'm the tourist. And it's amazing how the Prime Minister on this anniversary has been pushed aside by the shock that we're 1 year on.
It's shocking because everybody thought that it would be something that would get taken care of quickly or get over, or that would be resolved. It has become something that's dragged on. I want to really highlight something that Dombrovskis said. He said that the EU should confiscate frozen Russian assets and use Russian money to rebuild Ukraine. This is something that has been a growing theme, how to rebuild Ukraine after. How different nations are preparing to do that, to finance that, to construct it in all these different ways.
Two things. One, Volker Landau of Deutsche Bank was on this literally the day we spoke to him. I believe it was the 25th of February last year. And I get that idea. I did a panel with Ned Phelps, a laureate, and a guy named Jeff Sachs at Columbia years ago. And they're doing a panel on the rebuilding Afghanistan while the war's going on.
Right.
And I have real trouble personally with rebuilding discussions when I'm reading Ambrose Evans Pritchard in the Telegraph or our great team over at Bloomberg Opinion talking about how we have dominance over the Russians, but they're Russians on the border before a great battle, and they're Russians on the border before a great battle. It's a stew here.
Your point is so important, and it's something that's a little perverse to talk about almost.
Perverse is right.
When you look at the catastrophe that's unfolding for a lot of families and a lot of individuals that are on the ground and subject to this war, it is the backdrop which has raised that many more questions about all of the optimism that's come out, and frankly, the very low oil prices, both oil and natural gas falling to some of the lowest levels that we've seen since the Russian war in Ukraine. I just wonder how much that narrative starts to shift, especially with this flow of money into Europe over the past month and a half, whether that starts to perhaps balance out as we've seen over the past couple days.
We will see on this 1 year look back, as we see from Munich with Maria today. A futures negative 23. Lisa Bramos and I looking at yields higher. 2 year elevated 3 basis points, 4.67%, 3.89 on a 10-year yield. The fragility of equities apparent. Futures negative 23. Please stay with us on Bloomberg Television and Bloomberg Radio. Good morning. This is Bloomberg's Surveillance.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far. But if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset? monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Coming off the back of the biggest one-day loss of the month so far, are we going to add to it and take some more weight off the S&P? Futures right now down 0.5%. From New York City this morning, good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, equities heading for the first two-week loss of 2023 as Fed hawks float a return to larger hikes and President Biden tees up a phone call with Xi. We begin with the big issue, the return of 50.
Maybe the Fed is on the table to do 50 basis points.
50 basis point rate hike.
At the next meeting,
look at all of the data.
The extremely strong data.
The CPI print.
Surprise the upside.
Just not coming down quick enough.
The Fed's going to have to be a little bit more aggressive.
The U.S. consumer is very strong. The labor market is strong.
Strong data, payroll.
Great jobs print.
The Fed is trying to manage it.
I think they light candles every day, hoping that they don't get a repeat.
We had to do this. Joining us now, Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge. Mohammed, fantastic to catch up with you, sir. We had to build on the recent comments in the last 24 hours, put together the data of the week together. President Mester yesterday saying she saw a compelling case for 50 at the last meeting. Do you see a compelling case for 50 at the next one?
So I saw a compelling case for 50 at the last meeting. I was afraid that we would get the balance of risks wrong, and we've ended up getting the balance of risks wrong. Look, I don't like seeing the Fed go 75, 50, 25, then go back up to 50. That's not a good way to run monetary policy. But I think that the probability of a 50 has definitely gone up. The repricing of the market has been quite acute.
Mohammed, you mentioned the balance of risks. What is the correct way of viewing the balance of risks right now?
The correct way of viewing the balance of risk is that you may stop too early on rate hikes. Look, in a perfect world, the Fed would have help from the supply side, and that help would have an immediate impact. Unfortunately, we're not in that world. So the Fed has got to get hold of this inflation genie. Look, John, it is not just people saying 50. Break-even rates have moved up. Look at this week's Economist. The cover is about sticky inflation. We've got to be careful that inflationary expectations don't get away from us. That's why I felt strongly, as you know, that they should have done 50 last time. And I'm afraid we're going to have this stop-go, which is going to be really problematic, because the last thing we want, John, is to tighten into a weaker economy, and that would be towards the end of the year, towards the second half of the year. We don't want to get there.
Well, at the moment, the economy doesn't look weak, based on the hard data we've seen so far through the month of January as we look back a month. Mohammed, is there reason to believe, based on the January hard data, that we get a repeat of that this month in February?
I mean, the data has been consistently strong, John. It's not just the jobs report. It is retail sales. It is weekly jobless claim. You know, we may well get it. Of course, we won't get the 500,000 plus. And if we do, that would be a major, major surprise. But I suspect this is a pretty strong economy. Now, the forward indicators looking well, not beyond the next few weeks. The forward indicators are much more mixed, but the concurrent indicators are strong.
Mohammed, it was only a month ago we were talking about a disconnect between what the market was pricing and what the Fed was projecting. That spread has closed, and it's closed with the market coming up to the Fed and maybe going beyond it. We've seen from Jan Hatzius this morning at Goldman, 550, peak rate. We've seen from Bank of America's Mike Gapin just moments ago, 550, peak rate. That terminal rate, Mohammed, is there still upside risk around what we've already priced and what they're already projecting?
So, John, you may want to explain to our audience the British notion of selling someone a dummy that comes from rugby and comes from football here, which is this notion of you go one way and people follow you only to find out that it's gone another way. And that's what has happened. Whether it's the talk of disinflation by the Fed chair, or whether it was a January where we got a few favorable prints, the marketplace embraced something that now it's running away from. And I'm not surprised that we're seeing peak rates go up to 5.5 among some Wall Street analysts.
The Fed Chair Jay Powell, as you pointed out, and we discussed, talked about the disinflationary process beginning. He qualified it when he talked at the Economic Club of Washington, and he turned around and said it was just in the goods sector, we've got to see if it spreads to services. As you look at things today, Mohammed, with the benefit of extra data, would you say there's evidence that the disinflationary process has started?
Yeah, the disinflationary process has started. Inflation has come down. We're no longer at 9.1%. So there's no doubt the disinflationary process has started. It is the assumption that it's going to be smooth and continuous. And that assumption implied the following, John, that goods disinflation would continue, that services disinflation would start, and then you get the inflation going back to 2%. Now, I've always argued that service disinflation is much harder to achieve. It's much harder to get to with interest rates. What is surprising now is that people are starting to question the goods side. And the PPI number, yesterday's PPI number, is a major contributor to people saying, wait a minute, we may have not just service inflation problem, we may also have goods disinflation stopping faster. Look, there's nothing wrong with talking about the disinflationary process. You just don't repeat disinflation 11 times. Because when you repeat it 11 times, that's selling a dummy to the market.
And the market picked up on it, and now it's got to shift the other way. Mohammed, you mentioned rate sensitivity of this economy. I think there's two ways of looking at things right now. You can be in one of two camps. Either you believe there are long and variable lags, and the work they've already done is going to hit the economy down the road, and it's going to hit it hard, or you believe they haven't done enough. President Bullard said yesterday, and I thought this was a really interesting quote that more people should pick up on. He said, I've pushed back against the long and variable lags argument because I think in a modern era, the transmission of monetary policy is much faster than it would have been in the 50s, 60s, and 70s. Would you go with that argument?
He is generally correct. Yes, President Bullard is generally correct. The mechanism works much faster now through the asset channel, through the capital markets. It's not instantaneous, so it's not, normally they used to say 12 to 18 months. It is much shorter, but we haven't yet seen the full impact of what the Fed has done. So yes, he is absolutely right. The lags are not as long and not as variable as they used to be, but there's still some lags in the system.
How much of it is just guesswork? How much of this do you think is just pure guesswork?
I don't think it's pure guesswork, John. I think it's open-mindedness. I think it's a willingness to look at a whole range of data and be willing to revisit your priors. It's also important to anchor it over a longer term. You and I have been talking about this for the last 18 months. We have moved from an economy characterized by insufficient aggregate demand to an economy characterized by insufficient aggregate supply. That is not a cyclical issue. That is a secular and structural issue. So you've also got to be anchored by some long-term view of the economy. Otherwise, you get the flip-flopping. Otherwise, you get, what we've seen, which is the Fed leads the market one way, then the Fed leads the market another way, and now we're going to be led back. It's going to feel a little bit, not completely, a little bit like what it felt like in August.
So, Mohammed, to your point, though, there are some issues right now the Fed can do things about. There are other issues that are completely out of their hands. So as a policymaker, the balance of risks around all of this, what are you meant to do?
You're meant to take a comprehensive view, figure out what the balance of risk is. And the balance of risk right now is that the Fed loses further inflation credibility. And that is problematic because that's how you get a recession. If the Fed loses more of its inflation credibility, which already has been hit by two big policy mistakes, if it loses more of it, it will have to hike even higher than it would have had to do otherwise. And that will happen towards the middle of the year. And that will happen when the economy will not be as strong, and that's why we risk a recession. Now, we can avoid a recession, and we should avoid a recession, but the Fed has got to be really careful not to lose further credibility.
Mr. Harner over at Bank of America wrote this morning that no landing in the first half means hard landing in the second half. Just the idea being that this Fed is going to have to go harder. I think it was Barclays that said this morning the cost to pay for resilient growth is higher rates. Now, Mohammed, you go with that. There's no landing concept in the first half and a hard landing in a second.
Yeah, I hate the phrase no landing because it implies, I live in a world where you can bring down inflation without destroying jobs and livelihoods. You don't need to destroy jobs and livelihood to bring down inflation. You need to act early enough. You need to be on your guard, and you have to have cognitive diversity, a broad mindset. So, John, if, of course, you end up following the wrong approach and then have to do much more than what you would have had to do otherwise, yeah, then you can get a hard landing.
Is that window still open? Do you really believe that they can get CPI back down towards 2% without getting unemployment through 5%?
I don't think they can get CPI to 2% without crushing the economy. But that's because 2% is not the right target for our economy. When you have so much stuff going on the supply side, an energy transition, a change in the supply chains, geopolitical issues that come onto the supply side, the way the labor market functions, it's a long list of supply issues. You need a higher stable inflation rate, call it 3 to 4%, to allow for the lubrication that's necessary for these changes on the supply side. But you know what, John, you heard me say this when I was with you last time. You can't change an inflation target when you've missed it in such a big way.
Well, you can't change the target, but maybe you can tolerate an above target inflation rate and just tolerate it, Mohammed. Now, you've mentioned that a couple of times now, and I'm picking up on it.
I think that's where we're going to end up.
You think that's where we go?
That is where I hope to go, and I hope that that's a stable world, John.
Do you think they're going in that direction now, ultimately?
I don't know. For that, you'd have to ask our colleagues on the FOMC. I don't know where they are. I don't think they know where they are. They are too data dependent. It is right to take data into account, but you've got to have a view of where you're going. It's like driving on a freeway. Yes, take into account how fast the other cars are driving, but you need to know where you're going. You need to have a view of how you're going to get to that destination. And that's why it's really important to have a secular and structural anchoring to your data dependency.
Mohammed, this was great. I feel like I should lose the tie, though. What's this about? The Friday look now? No tie? Is that what we're going with?
Well, I thought, I can't wear the same tie I had with you on Tuesday, so it was not tie.
Mohammed, thank you as always, sir, for being generous with your time. A good friend of ours, a good friend of mine on this program. Equity futures right now down 0.5%. Yields in the bond market a bit higher, 467 on a 2-year. Coming up, President Biden looking to ease tensions with China.
We seek competition, not conflict with China. We're not looking for a new Cold War. I expect to be speaking with President Xi, and I hope we're going to get to the bottom of this.
We're live from the Munich Security Conference. Up next.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
We don't yet know exactly what these three objects were. But nothing right now suggests they were related to China's spy balloon program. We seek competition, not conflict with China. We're not looking for a new Cold War. And we'll responsibly manage that competition so that it doesn't veer into conflict. So I make no apologies for taking down that balloon.
Been quite a couple of weeks, hasn't it? President Biden looking to clear the air with President Xi. This as Secretary Blinken is said to be weighing a meeting with China's top diplomat on the sidelines of the Munich Security Conference. Beijing pledging to limit its use of sanctions after adding 2 U.S. defense companies to its blacklist. Bloomberg's Maria Tadeo joins us now from the Munich Security Conference. Maria, wonderful to have you with us. I've got to say, a packed agenda for you. What tops it?
Yeah, a lot going on here, Jonathan. And of course, we talk about the war in Ukraine, the concerns about this new offensive. We just heard from the French president, by the way, Emmanuel Macron, saying this is not the time for negotiations. We're not there yet. Ukraine has to win the war and Russia has to lose it, essentially. Very strong words from the French president. Of course, the question is, what are Europeans going to do to ensure that Ukraine gets the weapons and the training they say they need to be able to counteroffensive and push back the Russian forces? The other big issue, which kind of feeds into what you were just talking about on the show, is China and the United States. That's a big topic going into this conference. It is known by now that these are two countries that obviously compete, that are rivals, but can you have competition without conflict? And the beauty of a conference like the Munich Security Conference is that it removes away the protocol that comes with an official trip. And there's a lot of meetings that happen behind the scenes, sometimes in a quiet room. They're not official, but yet you do get a sense that there's some kind of back channel communication. I think to me that will be interesting. By Monday, do we get a sense that somehow tensions from this balloon, or I'm not even sure how we describe it at this point, have cooled down between the two sides?
Maria, looking forward to your coverage, particularly tomorrow. I know you're sitting down with the British Prime Minister Rishi Sunak. Really looking forward to that conversation. Maria Tadeo in conversation with Rishi Sunak, the British Prime Minister. That will take place tomorrow. And when I'm back after the long weekend on Tuesday, we'll pick up on some of that. Maria, thank you, as always. The Fed hawks were out in force in the last 24 hours. I have to say the ECB hawks were out in force this morning, including Isabel Schnabel of the ECB Executive Board, saying she sees a risk that markets will underestimate inflation. Let's put all of this together with BMO's Carol Schleif and Evan Brown of UBS. So the two of you, thanks for being with us. First of all, to you, Carol, we've got the Fed talking of 50 again. We've got the ECB saying we've got more to do. Where are you on how far these central banks are going to go?
I think similar to what you're previous to what Mohammed said, that there's definitely going to have to be a higher terminal rate, but picking that rate, and the markets have been ignoring it for the last year and a half, really fighting the Fed step by step by step here. And the Fed's been very clear about the higher for longer, and you've got good, solid economy underneath and lots of inflation moving through the system, even if that rate of inflation is slowing somewhat. So we've been saying all along we thought the Fed could stick a soft landing, but also that they were going to have to not cut this year and stay higher for longer. That's been our theory for a very long time.
Evan, it's been yours as well. You expected decent economies, you're getting them. You expected sticky inflation, you're getting it. Did you expect these market outcomes in the first couple of months of 23?
Well, did expect that yields would rise and that we'd have a decent move in equities. Did not expect that you'd see growth equities leading the charge. That's been the main surprise to us, that the resilience of big cap tech, and in particular the profitless tech and crypto and these kind of things. I think that's on borrowed time, though, because as you are in this higher for longer environment, just gravity is going to have to come back as people switch into cash, which is increasingly attractive.
There's just this temptation that we go back to 2019, Carol, that we're just going back to the pre-pandemic regime. Is there any evidence of that whatsoever?
I don't think we're going back to pre-pandemic in any way, shape, or form, either in the economy or in the markets per se. And what led going into a downturn like you've had over last couple of years tends not to be what leads coming out. But there are a lot of interesting things out there that could potentially lead intermediate and longer term, even just looking at the kinds of industries that are teed up by all of the fiscal spending and the special acts that have been passed recently to bring us into a 21st century and a greener technology and reshore. So it's looking for growth in different places, and you're seeing it in some of the earnings commentaries from some of the old industrial companies even. So it's happening, but the market hasn't recognized it. So looking to the past for what leads in the future, we think is a wrong-footed mindset.
Carol, can you build on where you think that leadership is going to come from? And how long this process might take to evolve? Because I think people were just seeing it as a one-off event. You wake up in 23, it just happens.
No, I don't think it just happens. And we've teed up over $1.3 trillion worth of different investment in areas like semiconductors, green technology, green grid, building out the infrastructure for charging stations, for example. We haven't, in a massive way, invested in the productive capacity of the United States in decades, arguably since we built out the interstate system and started ramping up the space system in the 50s and 60s. And we're teeing up incentives to do that now, both credits and spending and incentives, much of which must be matched. So looking at industrial companies, looking at companies that play in the construction and the refurbishment of infrastructure, looking at companies that build plant and equipment and put the sensors in there and the technology in there and the artificial intelligence in there, and you're seeing lots of that commentary come in terms of record backlogs on some of these companies as they reported their last set of earnings. So hopefully we're able to absorb some of those workers that are being laid off from the very smart workers being laid off from a lot of the tech companies. Hopefully they find other homes and help generate that productive capacity. But it does take time. And so hopefully we see the green shoots of it now, but it might play out over the next year or two until the market's focused on the new leadership.
Well, so far the markets, and I think the financial media, focused on the outperformance in big tech. But elsewhere, Evan, beneath the headlines, all-time highs on a FTSE in the UK. In the last 24 hours intraday, we saw record highs in Paris, France on a CAC 40. We've seen some of the luxury names, the airlines, absolutely flying. The miners over in London before the end of 2022 started picking up really well as well, Evan. Do you see that move as durable? Do you think that can be sustained?
I do, yes. I mean, I think what we're seeing right now is kind of a mini reflation. Everyone expecting recession coming into the year. It's not just soft landing right now. It's actually, we're getting a re-acceleration in the global economy. It started to come through in Q4 with Europe looking better, China reopening, and now we've got some really strong U.S. data. Where we are is that driver of re-acceleration is going to shift again more towards China. That we've had the relief trade in China, but we have not had the real recovery trade just yet. And when it comes down to it, President Xi wants a stronger economy, which is what he's communicating. he's going to get a stronger economy. You know, he's going to, if there's not enough consumption, not enough of housing support, then that will come. So it's going to be a really interesting year because you've got multiple growth drivers. I hear what people are saying, that financial conditions, you know, they're with a lag going to hit the economy. But right now, everything we see is more in the reflation category than recession.
It's going to have big consequences as well for the dollar call too, and Evan, we'll talk about that another time. Evan Brown, thank you there. Carol Schleif to the both of you. Fantastic. Looking for that leadership coming from elsewhere, like Richard Bernstein a little bit earlier on this week. We'll pick up on that around the open and bout. 7 minutes away from the open. Coming up, the morning calls in later. Clear Harbour's Aaron Cannon recommending investors proceed with caution. Poor fundamentals, sticky inflation, keeping a lid on equities. That's the call from him and many, many others. 7 minutes away from the cash open. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
A little more than 4 minutes away from the open and bout. Equity futures down about 0.5% off the lows. They fade just a little bit. We'll get you to the open in just a moment. Let's get you some morning calls. First up, Bank of America upgrading Roku to buy from underperform, expecting new partnerships to boost advertising and improve margins. That stock's up almost 4%. Evercore downgrading Canada Goose to inline, $20 price target, calling the company's new long-term targets needlessly aggressive. That stock's down 2.6%. And finally, BTIG upgrading DraftKings to buy after earnings, saying the company is now positioned to be more aggressive with future growth initiatives. That stock up by more than 12%. It's flying. We'll pick up on that at the open. Coming up, Clear Harbour's Aaron Cannon seeing a weak setup for stocks amid lofty valuations and persistent inflation. That conversation is up next. Your opening bell just around the corner.
reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Coming off the back of the biggest one-day drop on the S&P of the month so far, heading towards the first two-week loss of the S&P 500 of 2023. Equity futures going into the opening bout, taking some more weight off the S&P. We're down 0.6% on futures here. On the Nasdaq, down 0.75%. Tech running into some trouble in the bond market. There's the opening bout. Switch at the board and get to bonds. We look a little something like this on a 10-year. Yields higher by 2 or 3 basis points, 388. We were through 390 a little bit earlier on this morning. On a 2-year, we were through 470. We've backed away since then. On a 2-year right now, yields are still just a little bit higher by 3 basis points at 467. Dollar strength, though, making a comeback. Euro dollar negative 0.25%, 106.46. And crude softer, negative lower down here by almost 4%, $75 and about 50 cents. We're about 20 seconds into the session. We're down 0.5% on the S&P. On the Nasdaq, we're down 0.7. One stock to watch at the open, DraftKings, raising its full-year outlook with the CEO saying this: moving into 23, we'll continue to drive revenue growth and focus on expense management to accelerate our growth. That stock is up by 14%. Abby, it's flying.
It is flying, John. In fact, it's the best day of the year, the best day since November 10th of last year, and a big quarter, so it seems to be justified. This is a part of this travel and leisure rally that we're seeing this year into today. This stock up 56%. The quarter that they just posted, absolutely fabulous. They beat revenues, but they not only beat, it was 81% growth. They're focused on cost cutting, so that also helped them post a narrower loss than expected. Very importantly, they raised the view. Now, business is booming. It has a lot to do with the fact that there is a lot of legal gambling going on out there. 33 states, it's now legal to gamble. So that's really helping numbers move in the right direction. Fourth quarter revenues of $855 million, more than all of 2020. We're looking at big year-over-year growth with just more potential as more states could come online. We're looking at the possibility of this company putting up nearly $3 billion in revenue this year, more than $3.5 billion next year. As for the rally in this broad space, John, it's incredible, these year-to-date numbers. So at this point, look at that. DraftKings up 76% this year, really blowing away some of these other big movers such as Airbnb, Warner Brothers, and Wynn Resorts. Folks really spending big time on this travel and leisure space, John.
I don't gamble on sports, but Jamie in the control room does. And Jamie showed me this morning that he won $800 and he's going to buy everyone breakfast after the show. So everyone in the control room, on the floor, if you're aware of that, that's happening. Abby, thank you. Jamie's going to love that. Another guidance meet from Dia. Dia, a beat and a raise. Higher crop prices keeping farmers' demand strong. The CEO, John May, saying this. Deere is looking forward to another strong year on the basis of positive fundamentals, low machine inventories, and a continuation of solid execution. Katie has more. Hey, Katie.
Hey, John. Well, like you said, grain prices are high, farmers are spending, and that is good news for Deere. A beat and raise quarter sales and profit both came in above forecast, and the tractor maker raised its guidance as well. The company now sees net income for fiscal 2023 coming in between $8.75 billion and $9.25 billion. That is well above the average analyst estimate of about $8.36 billion. And like I just said, Deere is selling more because farmers are making more. If you look at the farm gross income over the past 2 years or so, it's up more than 50%. Net income up a whopping 72% over that span. And all told, the value of U.S. farmland is up about 20% or so. So that translates into more tractors sold by Deere. That is the wealth effect in action, John. And you can see it in the share price. I think this next chart is really fascinating. If you look over the past 3 years or so, the S&P 500, it's up a pedestrian 20%. Deere is up almost 150% in that time. And this isn't on the chart, but just for context, Apple is up 87%. So Deere is really dominating.
Stock's flying again, up another 3%. Katie, thank you. That stock's dominating. The airlines year to date, I keep going back to this. So this is America. American Airlines is up 29% year to date. United up close to 30. Delta up by 16 or 17%. That's the story with those names. Look to Europe, you see the same thing. I'll do Air France year to date for you just quickly. Including today's move, up about 45%, 44.5%. Up today by another 6. It's not just them. It's Deutsche Lufthansa as well. That stock's up by 25. Finnair. Don't know if you've ever traveled with Finnair, but that stock's up by about 50% year to date. Air France up 6% just in today's session after 4Q earnings, expecting a return to full passenger capacity and an exit from state aid in the coming months. The CEO said this: we close out the year with a positive net income, having turned the page on COVID. So many of the airlines getting a big bounce, and a lot of this stuff, luxury players, miners, the airlines, it's all taking place over in Europe as well. I want to pick up on that story because a lot of people are starting to look for opportunities outside of the United States. We've heard that a lot on this program over the last few months. Here's what RB's Richard Bernstein had to say.
The U.S. market is dominated by three sectors. It's dominated by tech, it's dominated by consumer discretionary, and dominated by communications. Those three sectors still make up about 45% of the U.S. market. What we found in 2022 was that country performance was directly related to how little exposure the country had to those three sectors. There's plenty of opportunities, whether it's in Europe, whether it's in Japan, whether it's in China. The menu of opportunities is extraordinarily broad.
Barclays looking abroad as well. I keep hearing so much of this, you do too. This is what they have to say. With growth holding up better than feared, more sensible rate expectations priced in post the hawkish central bank talk, and positioning still not stretched, cautious optimism on EU international equities still feels right to us. Clear Harbour's Aaron Cannon joins us right now. Aaron, great to have you with us. It's been a while. We should catch up more often. Let's start with that story. International. Does that make sense to you still?
Yeah, I think, at the end of the day, diversification is that sort of last free lunch for all of us as investors. And, certainly Europe in particular, just taking off on the last remark made, Europe in particular has been under significant amount of pressure. And a lot of that was due to the idea that energy prices would remain extraordinarily lofty, really, pushing industrial giants out of the economy and making them far less competitive than, let's say, those in the United States. That dynamic has surprised to the downside in terms of cost pressures. And so Europe's certainly more competitive, and that's been a bright spot year to date. I think a lot of investors have been caught off guard with that.
Well, it's helped send the FTSE to a record, Aaron. It's helped send the equity market in Paris to a record as well. But at the same time, something else has been taking place, which I think has taken the headlines away from that story, and it's been the dominance of tech. And if you afford me the time, I'll just go through some of the numbers. Before today's session, Meta up 43% year to date, Tesla up 64%, Apple up 18%. These are big moves. And what's interesting about the moves in tech, Aaron, I get a lot of people coming on and say, I question that. It doesn't make sense. Look at what's happening in rates. So show them what happens in Europe, and they can justify it. And what I'm trying to figure out, Aaron, is can you get a correction in US tech and still get that performance in the European story that people seem to have more faith in?
Yeah, I certainly think the answer to that is yes. I mean, at the end of the day, I think, looking further out, we have to think about the interplay of equities and the equity risk premium with the fixed income market. And if one argues that we're going to have a more hawkish ECB and a more hawkish Fed, as we have just over the last few days, I think now priced into the market, I think those are both ultimately, at least near to medium term headwinds for the equity landscape. And I'm not sure that's priced in, not to mention the idea that earnings are flat and are certainly not even pricing in a modest recession yet. And so if we were to do that, right now, if you look at the U.S. equity market, John, we're trading at almost 19 times forward earnings multiples, and we have rates having gone from 1.5% in the 2-year Treasury part of the curve to 4.67 here this morning. That would suggest to me that equities need to adjust. Technicals remain strong, but fundamentals are really not all that attractive at the moment, both in tech and really across the board. Certainly, there are opportunities when you lift up the hood, but the overall market is not particularly attractive, both in Europe and here in the U.S.
You've said to me before that the peak in Fed funds rate should coincide with the peak in the 2-year. Based on how well priced the 2-year is right now, are we getting closer to that point?
Well, it seems as though we are, but as we approach the peak, it seems like the Fed funds futures market is pricing in another rate hike. And so we now need to wait until about mid-2024 to see a rate cut. And will 2-year treasuries approach 5% is almost the implication of your question. And I think there's certainly a chance that if it looks like there's a 25-25-50 or 50-25-25 priced in, we could certainly see the 2-year move higher here. But if you look at long-term inflation expectations at 2.35, 2.40, and you look at the 2-year part of the curve, 2-year treasuries look reasonably attractive.
It's not just the Fed, though. It's the ECB as well. We mentioned that on the program a little bit earlier. The ECB's Isabel Schnabel was speaking a little bit earlier this morning, Garen. She said risks are that this market is underestimating inflation. Now, that's the Fed. That's the ECB. And I guess the real unknown is whether the BOJ joins in. Do you expect they will?
It's going to be really interesting, John. I think that we may be in the midst of a tectonic shift in how we think about the Japanese interest rate regime, how we think about disinflation versus reflation. They've been fighting it for 20 years. We have a new regime coming in, and we have inflation in the world and a bit of inflation in Japan. And even if the Bank of Japan moves off the 0 to 50 basis point bound, which I suspect there's a rising likelihood that that's going to happen, there could be a rather significant capital shift. Mr. and Mrs. Watanabe, the savers in Japan, have been doing the carry trade, have been taking their Japanese yen, have been reinvesting them overseas for the last 20 years in higher yielding fixed income and to some extent equities. And to the extent that it now appears as though maybe the Japanese Bank of Japan moves off that 0 to 50 basis point bound, you could see a lot of reshoring of capital and has huge consequences for the yen. I think it increases the likelihood of a stronger yen going forward. And it has huge repercussions, of course, for demand for fixed income here in dollar-denominated assets, in euro, in Brazil, everywhere Mr. and Mrs. Watanabe was buying over the last 20 years. You could start to see a bit of a fading of demand on that front. And I think we need to be thinking about that as investors.
Where do you think is most vulnerable? You mentioned the US, you mentioned Europe, specifically fixed income there. We know that story. You mentioned Brazil as well. Where do you think is most vulnerable?
Well, I mean, there are a lot of moving parts there, but undoubtedly the Japanese capital allocation has been heavy in US dollars, has been heavy in euros as well, and to some extent Australia and New Zealand, on the margin in Latin American places like South America and Brazil. And so, I think it's all on the margin. Certainly US dollars are a function of that. Now, will 10-year treasuries trade higher in yield because, maybe 6 months from now we see the Bank of Japan shift policy? Could that be a catalyst? I'm not sure if the force will be that strong, but I think the most significant point here is the likelihood of a stronger yen going forward.
When do you start to think about maybe sovereigns struggling with some of this? The argument going into this rate hiking cycle was that the Fed couldn't go only so far, because once they got to a certain level, it would be problematic because we have so much debt, particularly with the sovereign, and they'd have to back away. And then here we are talking about 550, maybe going even further, and the ECB joining in and going 375, maybe pushing 4. When do you start to think about sovereign debt issues in DM, not EM, in DM?
You know, an analogy, when you ask this question, I remember during the COVID crisis when oil traded negative. We sat around here in the office and said, well, you know, we don't think oil is going to trade at negative to zero for a long time. But if it trades at extraordinarily low levels, well below lifting costs of oil companies, how long can they stay in business? And you're asking the same question, but at the government level. And I think that's the challenge of the moment. And I think central banks are fully aware of that. Every 1.5% rise in the weighted average cost of capital of the U.S. government adds $450 billion to our interest payments. I mean, that funds almost more than half of our U.S. defense budget. And so this is a huge challenge. I think the Fed is fully aware of it. The Treasury is fully aware of it. And that's another reason why we need to fight off inflation sooner rather than later, because time is of the essence in some sense in moving back down to the 2% bound.
Or do you think ultimately, as Mohammed alluded and suggested, that we just have to accept a higher inflation rate?
Well, you know I did see him earlier on your show. We'll have to see. That's not going to happen overnight. I think the central bank's going to fight that. From a communication perspective, quite hard. And frankly, there are, as Mohammed even alluded to, there are initial and rather significant disinflationary trends currently in the market. So I know the narrative of the last week or two is inflation is here, it's going to be sticky, the Fed's going to raise rates. But if you look at M2 money supply, gosh, it's now negative on an annualized basis, and we haven't seen that since the Great Depression. You look at certain aspects of the economy, wages are decelerating on the margin. You look at core CPI and you sort of remove the shelter component, and it really was only up fractionally, I think like 0.2% month over month in January. So there are trends, but certainly the challenge is, not to sound like a broken record, employment remains strong, retail sales and consumption remains relatively strong. And that consumer is still, chasing goods in a way that's keeping inflation perhaps more lofty for longer.
Yeah, big time. That's the story of the week, story of the year so far. Aaron Cannon. Aaron, thank you, sir. As always, it's good to catch up. About 15 minutes into the session, we're down 0.75% on the S&P, on the Nasdaq, down almost 1 full percentage point. Coming up from Wall Street to Silicon Valley, the job cuts keep piling up.
We have been seeing earnings estimates coming down already. You've seen the margins compress. You've seen layoffs being announced.
That conversation still ahead. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, That's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
The top names at the Fed are on Bloomberg.
Inflation is normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
You've seen layoffs being announced. You have been seeing earnings estimates coming down already. You've seen the margins compress. This market feels like a patient that has taken the medicine, but the medicine hasn't fully developed its impact yet.
You don't see it in jobless claims, but you hear it from big companies. Job cuts. Bank of America, the latest firm on Wall Street to cut back, announcing plans to reduce headcount within the investment bank. In the tech space, weakening PC demand, forcing Lenovo to warn about upcoming layoffs, and even Apple beginning to cut ties with contractors. This according to the New York Post. Team coverage begins right now with Sonali Basak here in New York, Ed Ludlow on the West Coast. Ed, first to you. Walk me through that Apple story.
Yeah, it's important. You know, we've written a lot at Bloomberg and done the data analysis on how Apple hired more prudently, judiciously over the pandemic period and boosted its revenue per employee, and so therefore has been the only mega cap so far not to do layoffs. What the New York Post is saying, citing unnamed sources, is that they have a large body of contract workers in the thousands, though Apple's never disclosed it, that they are now starting to cancel contracts early. Many of these contractors are hired on a 12 to 15-month basis, and according to this New York Post report, they're actively canceling those contracts, as well as some of the sort of vendor agreements they have with third parties for events and such. That chart is what I'm talking about, right? That's on the screen right now. Look at how Apple hired or grew headcount over the pandemic period, and it tells the story of why they have not done mass layoffs so far. I've asked Apple, I've written to them this morning and said, can we talk about this? You know, what is the truth of this? What's going on here? Because they have not made that kind of specific action. Very quickly on Lenovo, John, this is a company that had 82,000 employees as of the end of the September quarter. That's the latest data we have. The CEO of Lenovo, the world's biggest PC maker, did not say how many they would cut, but it would be a small proportion of overall OPEX reductions that they're targeting. So an ongoing theme on the Lenovo side because of the slowdown in the end user market.
So that's tech. Sonali, I think Ed's right to frame it that way. It's about overhiring excess through the pandemic. What is it in the financial world?
It's certainly true, John, that you saw banks hire significantly, do acquisitions, and hire a lot of people to meet the demand of a lot of business during that time frame. But think about Bank of America alone. When you look at December, Brian Moynihan said he was not looking to cut jobs in the investment bank. They were slowing hiring. What they were trying to do is pull every lever they could. They moved investment bankers to different parts of the business, but now that they're starting to cut jobs, you and I started the beginning of this week talking about Goldman Sachs, wishing that they started this exercise earlier. In a couple of months from now, will Bank of America be doing the same thing? Is this a signal of having too many bodies to meet the current macro environment? Or is this a signal that they believe things will continue to get worse because they can't keep these 200-some people on staff? It's a question of whether this will get much worse from here. Remember, 200 people at Bank of America. It's not a lot in the grand scheme of things. But again, remembering that they had spent months and months and months trying not to do this has been a big thing when you look at now a crack starting to crack even more in the Wall Street hiring market.
Sonali, thank you. Appreciate it. I know you're going to stand top of that story. And to you, Ed, The no-tie thing on the West Coast is totally fine. That works. It's all right. Looks good, buddy. Looking forward to the show later.
Friday.
Ed Ludlow, to you as well. Shanali Bassett, thank you. The latest comments from the Fed. Governor Michelle Bowman speaking right now, saying that inflation is still too high, not seeing what they want to see in the inflation data. This is no surprise to you. Need to continue hiking rates until we see more progress. This coming off the back of the remarks, of course, yesterday from Loretta Mester, who's a non-voter, coming out and saying she saw compelling reasons to go 50 at the last meeting. And Jim Bullard of the St. Louis Fed, also a non-voter, saying almost exactly the same thing. The governor of the Fed, of course, has a vote. So Michelle Bowman, worth looking out for those headlines as they come through in the next couple of minutes. Want to get you some sector price action? We've got time for that. Here's Abby.
And it's unclear, John, whether or not those headlines are influencing the S&P 500, but it is trading at session lows, perhaps on the idea that the Fed is going to be raising and hiking longer than expected. Sector-wise, most sectors are lower. Energy, the worst, down 3% as oil falls for a fourth day in a row. And we're looking at 2 weeks of losses for the S&P 500 overall, the first time, John, that we've seen that this year. But we've got some winners and losers to the upside. Autos and tech on the downside. Energy, interestingly, is down 6.4%.
Abby, thank you. Appreciate it. Your trading diary up next.
Typically, between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
25 minutes in, we're down for a second day on the S&P. We're down for a second week, potentially, if we close this way. We're down about 1% on the S&P, on the NASDAQ, down by 1.4, taking a bite out of the year-to-date gains on that index, and it's been pretty punchy stuff. That's the move in the equity market. Let's get you the trading diary. Coming up, U.S. markets closed on Monday for President's Day. Long weekend here stateside. Earnings from Home Depot, Walmart before the open and bow Tuesday. FOMC minutes could be very interesting on Wednesday. Look out for that. Fed President Bostic daily speaking on Thursday, plus U.S. GDP, core PCE, and another round of jobless claims as we go towards the weekend. Looking forward to that. From New York City, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. And if you are stateside, enjoy the long weekend. That does it for me. This was the countdown to the open. This is Bloomberg TV.
Did art conservation help you in any way to be a better investor? And should a lot of good investors who learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales
every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake.
right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I am about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While while the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects